Hello Kanna, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to revise the capital gain chapter for CA Intermediate Direct Tax syllabus for May 26, September 26 and Jan 27 examinations. And you know what? This lecture is going to be the best revision lecture that you ever see on capital gain chapter, because in such a short amount of time, I am going to cover the entire chapter. Conceptually, this tough chapter of capital gain is going to be converted into an easy chapter for you, and after watching this you are going to solve all the questions of capital gain with ease, and you are going to rock in the examinations and score at least 10 marks in your intermediate examinations. So make sure to watch this video till the very end. You are going to be conceptually clear with the chapter and score marks in the exams. But as usual, before beginning, my humble request to you is to please like this video. If you appreciate my work, please let me know in the comment section with some good words to encourage me, motivate me. Subscribe this channel so that you never miss an update from my channel. And also, if you are watching this video initially, you will find a button called hype button below this video. Make sure to click that button and give me some points so that it reaches a newer audience as well. Now, without further ado, let us begin the most powerful revision lecture on capital gains chapter. So capital gain chapter is the fourth head of income, and like any other head of income, even capital gain chapter has a charging section and a computation section. Charging section is 45 subsection 1, computation section is section 48. Firstly, let us talk about charging section. Sir, what is taxable under capital gain head of income? In capital gain, tax is chargeable on the profit and gains from the transfer of capital asset in the year of transfer. So what is taxed? Capital asset is taxed. On what the tax happens? On transfer only the taxation will happen, and in the year of transfer only the taxation will happen. So now you should know what is capital asset, what is transfer, what are the transactions that are not regarded as transfer, to know the charging section better. So firstly, let us discuss section 2 clause 14, that is definition of capital asset. So what is capital asset, sir? Because capital asset is only covered in the capital gain chapter. What is capital asset? Section 2 clause 14 defines capital asset as, number 1, it is a property of any kind held by the assessee, whether or not connected with the business or profession. So the property is of any kind, whether it is personal property or business related property, whether it is tangible property or intangible property, whether it is movable property or immovable property. All kinds of property are capital assets. So in the first line itself, the act has brought all the types of assets inside the meaning of capital asset. So capital asset means property of any kind, whether or not connected with the business or profession, whether movable, immovable, tangible, intangible. Okay. However, there are some exceptions. So now let us learn the 6 exceptions to capital asset. It means what? There are 6 items which will not be included in the meaning of capital asset. So these will not be called as capital asset. What are they? Number 1, stock in trade. So stock in trade is a business asset. That is why it is not called a capital asset, because if there is sale of stock, it will be taxable under the profit and gains from business or profession head of income. That is why from all the assets, now it has removed what? It has removed stock in trade. So stock in trade is not capital asset. Stock in trade includes raw material also, consumable also, work in progress also, finished goods also. So all these are not capital assets. Then next one is personal effects. Personal effect means not capital asset. So personal effect means what? Personal effect means any movable property that I am having for personal use, that is only personal effect. For example, I am having a pen. This pen is for personal purpose. This is also a personal effect. I am having a car. That car I am having only for personal use. So this is also a personal effect. Like that, all the movable assets for personal use are personal effects. That is why on all these personal effects, they are removed from the meaning of capital asset. It means what? There will not be any capital gain. So if I am having a car which I am having for personal purposes, then if I sell that car and get a profit, will there be any capital gain? Answer is no. If I am having a pen, if I sell this pen and I get a capital gain, will there be any capital gain? Answer is no, there will be no tax, because it is not a capital asset. Fine. Is it beneficial or not? Sir, you will feel it is so good, no, that all these movable assets like car, pen, etc., whatever movable property we are having, mobile phone, it is never treated as capital asset. So we need not pay any tax on capital gain. But that is your assumption, Kanna. It is not beneficial for you. It is a loss for you. Sir, why is it a loss? Because if you are having a car, Generally, the value of car will not go up. The value of the car will come down, unless or otherwise it is a very luxurious car. So let us leave that. Generally, value of the personal effects don't go up, they come down. That since they come down, you will most probably have a loss, and that is why you will use that loss to set off against the other capital gain that the government does not want. That is why what they do, personal effect is removed from the meaning of capital asset. You got my point? But however, there are 6 personal effect that are still kept in the meaning of capital asset. You know why? Because these 6 assets are the assets whose value generally increases over time. It does not decrease. That is why the government has smartly kept it inside the meaning of capital asset. So these 6 are exception to exception. So exception to exception means what? These 6 are included in capital asset. Included in capital asset definition. What are they? You can use it to you can use this keyword to memorize it. That is Chad Spa, jewelry, archaeological collection, drawing, sculpture, painting, or any other work of art. So what did I say? Jewelry, archaeological collection, drawings, sculpture, painting, or any other work of art. So these 6 type of asset are personal effects. So for example, I am having jewelry. Jewelry is for personal use and it is a movable item, correct? So it is a personal effect. However, it is excluded from the meaning of personal effect. It means that jewelry will be considered a capital asset. Similarly, archaeological collection, drawings, sculpture, painting, or any other work of art will be considered as capital asset. So what did I say? Personal effect is not capital asset, but jewelry, archaeological collection, drawing, painting, or any other work of art will be considered as capital asset. Fine. Now let's talk about jewelry. Jewelry here means ornaments made of gold, silver, platinum, or any other precious metals, and also precious or semi-precious stones. So not only metal, even if there is precious stones, still it will be considered as jewelry, and whether or not it is set in any furniture, utensil, or wearing apparel. So for example, if there is a gold plate, that is jewelry. But if there is a silver plate, is it jewelry? Answer is no. Silver plate is not jewelry because generally on silver plate you have the food. That is why it is not considered as jewelry. But gold plate is considered as jewelry. Similarly, if there is any sari, on that sari diamonds are there, will it be considered as jewelry? Answer is yes. In the crown, it is made of precious metal and some diamonds are there. Will it be considered as jewelry? Answer is yes. So jewelry does not mean only wearing apparel. Even if in the furniture or utensils some precious metal or precious stone has been used, that also will be considered as jewelry. Fine. Now let's talk about the other items which are not included in the meaning of capital asset. So first is rural agricultural land. So rural agricultural land will not be considered as capital asset karna. So what is rural agricultural land? Rural agricultural land means a land on which you do agriculture which is there in rural area. But sir, what is rural area? Rural area means not urban area. Not urban area. So if the area is outside the urban area, it means it is rural area. But sir, now you tell me what is urban area. Don't tell me urban area means not rural area. Please tell me the definition of urban area. Okay, Kana, I will tell you. Definition of urban area. So let's take an example of Chennai, Kana. Let's take an example of Chennai. If the population of Chennai is, let's say, exactly 10,000, then Chennai will be considered as urban area. If it is less than 10,000, then it is not urban area. If it is exactly 10,000, it will be considered as urban area. And you know what? If the population is more than 10,000 up to 1 lakh rupees, then outside 2 kilometers of Chennai also will be considered as urban area. If the population of Chennai is more than 1 lakh up to 10 lakh people, then outside 6 kilometers also will be considered as urban area. Moreover, if the population of Chennai is more than 10 lakh people, then outside 8 kilometers also will be treated as urban area. So this entire area is urban area. If any land is falling outside the urban area, then it will be called as rural land. And if on the rural land you are doing agriculture, it will be called as rural agricultural land. Fine. So rural agricultural land is also not a capital asset. Then some small points. Specified gold bonds of 1977 or 1980 also will not be considered as capital asset. Then special bearer bonds of 1991 also will not be considered as capital asset. Then gold deposit bond under gold deposit scheme 1999, gold monetization scheme 2015, and gold monetization scheme 2019. They also will not be considered as capital asset. Moreover, you know what? For gold monetization scheme 2015, if the assessee is receiving interest, then that interest is also tax free. It is totally exempt from tax. Okay, under section 10 clause 15. This you would have learnt in your income from other sources chapter. Fine. So these are all exclusions from capital asset. So once more, I am telling you what is capital asset. Capital asset means all the property, whether personal or business, whether movable, immovable, tangible, intangible. But it does not include stock in trade. It does not include personal effect. It does not include rural agricultural land. Does not include specified gold bonds of 1977, 1980, special bearer bonds 1991, and then gold deposit bond under gold deposit scheme 1999, gold monetization scheme 2015, or gold monetization scheme 2019. So all these are not capital asset. However, in personal effect, 6 type of items are there which are personal effect, but still they will be considered as capital asset. That is JADSPA, jewelry, archaeological collection, drawing, sculpture, painting, any other work of art. Now let's see point number B. Now what else is capital asset? Let us see. So second point, in this there is an amendment also which is applicable only from May 2026 onwards, but not very important for you. Just if you know this much, it is enough. Just if you know the name, it is enough. If at all it is coming in MCQ, then you should be able to answer. So what is the second point? Any security held by a foreign institutional investor or an investment fund specified under section 115 UB as per SEBI guidelines. So if any security, that is shares etc., which is held as per SEBI regulations by a foreign institutional investor or investment fund specified under section 115 UB. So for these two category of people, if they are having any security, it will always be considered as capital asset. It will never be considered as stock in trade. Okay, so always if they are having any income from security, it will be taxable under capital gain chapter. So what is the meaning, what is the reasoning and all we have discussed in regular batch. I hope that you remember the points that I told you, the story that I had told you. The third one, any unit linked insurance plan to which section 1010D does not apply. 1010D we will be learning in income from other sources chapter, which tells what are all the life insurance policy which is exempt from tax. So other life insurance policy which does not, on which 1010D does not apply, it means what? Life insurance policy which is taxable. If that life insurance policy which is taxable, it is a unit linked insurance plan, then it will be considered as a capital asset, because ULIP is taxable under capital gain chapter, but for inter ULIP taxation is not there. For final syllabus only it is there, so don't worry. ULIP, but however you should know that ULIP also is considered as capital asset. So any security held by foreign institutional investor or investment fund is also capital asset. Any unit linked insurance plan that is not exempt under section 1010D is also a capital asset. Then interest on gold deposit bond I already told you. Now let's talk about transfer karna. We have already learned what is capital asset. I told you, transfer of capital asset is taxable. So what is transfer? Let us see. Section 2 clause 47 defines what is transfer, and transfer includes sale, extinguishment, relinquishment. So transfer includes sale, but other than sale also so many transactions are included in transfer. So what and all is covered in capital gain. Let us see. First is sale, selling from one person to another person. Then exchange of products or goods. Then relinquishment of any asset. Relinquishment means the asset itself is getting destroyed. And then extinguishment of any right. So the right in an asset is getting over. That is only called extinguishment of any right. Then compulsory acquisition. So if the government is coming and compulsorily acquiring the property, that is also considered as transfer. And whenever government is giving money, on that tax also you have to pay. So even compulsory acquisition is a part of transfer. Then conversion of capital asset into stock in trade. So if capital asset is converted into stock, that is also considered as transfer, and on the fair market value of the capital asset you have to pay the capital gains. That also I am going to cover in this video, don't worry. Then allowing the possession of any immovable property in part performance of a contract. So this part performance of a contract we have also discussed in house property chapter in deemed owner concept karna. There what did I tell you? As per Transfer of Property Act, if you have transferred the possession alone, sale registration is not done, but still possession has been transferred, in that case also the person who is receiving will be considered as the owner, and here also it is considered as transfer. So allowing the possession of any immovable property in part performance of contract will be considered as transfer. Then transaction having the effect of transferring or enabling the enjoyment of immovable property. So this also you should link with deemed owner concept in house property karna. There I would have told you that there will be a society or a company, and the building, it will be in the name of the society or company. People who are living in that building will be considered as member or shareholder. So if the member or shareholder is transferring their membership or shares to another person, then their flat in the building is also transferred to another person. So this is what transaction that is having the effect of transferring or enabling the enjoyment of immovable property. So if I am transferring the shares, then it is considered then that my flat is also transferred and I have to pay the capital gains. You get my point? And then lastly, redemption of zero coupon bonds. So redemption of zero coupon bonds is also considered as transfer. So what is transfer? Once again, very important. Sale, exchange, relinquishment of any asset, extinguishment of any right, compulsory acquisition under any law, conversion of capital asset into stock in trade, then allowing the possession of an immovable property in part performance of a contract, then transaction having the effect of transferring or enabling the enjoyment of an immovable property, and lastly, redemption of zero coupon bonds. So all these are considered as transfer. And now you know what is transfer. You should also know what are all the transactions not regarded as transfer. It is given in section number 47 Kana, that is transactions not regarded as transfer. You know what, whenever all these transactions are happening, no, the Income Tax Act will close its eyes. It will close its eyes as if nothing has happened. Okay, the Income Tax Act will, what they will do, it will close its eyes as if this transaction itself has not happened. That is why it is called as transaction not regarded as transfer, and that is why whenever these transactions are happening, capital gain will not come or it will not arise. So what are all those transactions? Let us see. First transaction is full or partial partition of HUF. So if HUF is partitioning the property, then property is going from HUF to the family member, no? So when the property is going from HUF to family member, so it is not a capital gain in the hands of HUF, not a transfer in the hands of HUF. So HUF need not pay any capital gain. Next, gift or will or irrevocable trust by an individual or HUF. So if an individual or HUF is giving a gift to someone, then the individual need not pay any tax under capital gains. Next, holding company to 100% Indian subsidiary company. So if holding company is transferring the asset to a 100% subsidiary company which should be Indian, in such case it is not a transfer. The holding company need not pay any capital gain. Next, if subsidiary company is transferring to its in 100% holding company which should be Indian, in such case also it is not considered as transfer. That is why subsidiary company need not pay any capital gain. Next one, when amalgamating company transfers to amalgamated company, then also it is not considered as transfer. However, this amalgamation, no, it should be as per the Income Tax Act. Only then this provision will apply. Now what is amalgamation as per Income Tax Act? Let us see. First, let me give you an example of amalgamation. Let's say there are two companies, Inox and PVR. Both are related to movies. Now both of them merged together to form another company called PVR Inox. So this type of transaction is called amalgamation. So what is amalgamation? Amalgamation means defined under section 2 clause 1b, which says amalgamation means one or more companies join another company or two or more companies merge to form a single company. Both type of transactions are called amalgamation only. So in Income Tax Act, amalgamation is also called amalgamation, merger is also called amalgamation. Fine. So both are amalgamation only. But what are the conditions? Let us see. There are three conditions. Number one, all the property of the amalgamating company should become the property of the amalgamated company. So here all the property of Inox should become property of PVR Inox. All the property of PVR also should become property of PVR Inox. Similarly, all the liabilities of the amalgamating company should become the liability of amalgamated company. So all liability also should be transferred to another person. And lastly, the amalgamated company. And lastly, shareholders having at least 3/4 shareholding in amalgamating company should get share in amalgamated company. So here at least 3/4 shareholder of Inox should get the new PVR Inox shares. Similarly, at least 3/4 shareholders of PVR should get the new PVR Inox shares. Only then it will be considered as transfer. Sir, what about the balance 1/4? But they will not get shares. For them you can give cash also and you can settle them, not a problem. But at least 3/4 shareholders are there, no? To them you should give the new company shares. So that is a rule. If all these three conditions are satisfied, then it is called amalgamation. And what did I say about amalgamation? When amalgamating company is transferring its assets to amalgamated company, it is not considered as transfer. The Income Tax Act will close its eyes when the transaction is happening. Next one, demerged company transferred to resulting company. So demerger, when it takes place, then also it is transaction not regarded as transfer, but demerger also is defined under the Income Tax Act. All the conditions should be satisfied. First, let me tell you an example of demerger. Let's say there is old Reliance company. In that old Reliance company, Jio Finance was there. Now that Jio Finance is coming out of old Reliance as a new company called Jio Finance, and now the balance company has become New Reliance company. So old Reliance has has split into two companies, that is Jio Finance and New Reliance. So this transaction is called demerger. So now let us see the conditions for demerger. What condition number 1? Transfer should take place as a going concern. It means what? Both the new companies should be continuing businesses. You should not close down any business. So Jio Finance also should be a running business. New Reliance also should be a running business. So that is first condition. Second condition, all the property of the undertaking being demerged should become the property of the resulting company. So in this old Reliance, first Jio Finance was a part of old Reliance. No. Now whatever are the assets of this Jio Finance should become the assets of the new Jio Finance company. Similarly, all liabilities also should be transferred. So property should be transferred, liabilities also should be transferred. Then property and liability should be transferred at book value immediately before the demerger date. So at what value? Book value it must be transferred. And similarly, last one, shareholders having 3/4 value of the shares of the demerged company immediately gets shares of the resulting company. So at least 3/4 value of shareholding of the undertaking being demerged should be getting the new company shares. So this is the condition for demerger. If demerger conditions are satisfied, then whenever demerged company, so what is demerged company in this case? The demerged company is old Reliance and resulting company is Jio Finance and New Reliance. Okay, wow. So demerged company is transferring to resulting company, then it is a transaction not regarded as transfer. Next point, shares issued by resulting company when demerger taking place. So now in this case I told you, old Reliance shareholders will now get Jio Finance shares, new shares of Jio Finance. In such case, what is happening? The person is giving up some right in old Reliance shares and getting the Jio Finance shares. This also will not be considered as transfer. So old Reliance shareholders need not pay any capital gain tax. Similarly, when there is this amalgamation happening, in that case also this Inox shares and all will expire, it will lapse, and then new PVR Inox shares will be given to the shareholders. In this case also, when the old shares are going out, new shares are coming in, this transaction also will not be regarded as transfer, so I need not pay any capital gain. So for example, if I am having Inox shares, what will happen? My Inox shares will get over and then I will get new shares of PVR Inox. In that case, I need not pay any capital gain because it is a transaction not regarded as transfer. Next one, government securities outside India from one non-resident to another non-resident. So if a non-resident is transferring government security to another non-resident outside India, then it is not taxable under capital gain. Next one, redemption of sovereign gold bond by an individual. Okay, so sovereign gold bond is an instrument given by the government. After 8 years, you have to redeem the sovereign gold bond. If at all sovereign gold bond is redeemed by an individual, then it is a transaction not regarded as transfer. No need to pay any tax on capital gain. Next one, conversion of gold into electronic gold receipt and vice versa. So there is an instrument called electronic gold receipt. It is like a digital gold which is issued by the government. So you can give the gold and get the electronic gold receipt, and later on if you want real gold, you can return back the electronic gold receipt and get back the real gold. So whenever you are converting gold into electronic gold receipt or converting electronic gold receipt into gold, in that case it is not regarded as transfer. You need not pay any capital gain tax. Next one, transferring JADSPA. What is JADSPA? Jewelry, archaeological collection, drawing, sculpture, painting, any other work of art. So transferring all these assets, then photos, printouts, etc. to the National Museum or Art Gallery or Public Museum. So when you are transferring all these type of assets to National Museum, Art Gallery or Public Museum, then you need not pay any capital gain. Next one, bonds, debenture stock, deposit certificate converted into shares or debenture. So when these types of securities are converted into shares or debenture, then it is a transaction not regarded as transfer. Bond, debenture stock, deposit certificate converted into shares or debentures, not considered as capital, not considered as transfer. Next one, preference shares converted into equity shares. So if I am having preference shares, now if they are converted into equity shares, should I pay any capital gain tax? Answer is no, because preference shares converted to equity shares is not regarded as transfer. The Income Tax Act will close its eyes. Sir, why again and again you are telling it will close its eyes? You will get to know, Kanna, when I am talking about cost of acquisition. No, that time you will understand. Next, transfer of assets by a company during liquidation. Okay, reverse mortgage vititana. Okay, first I'll take this. Transfer of capital asset under reverse mortgage. Sir, what is this reverse mortgage? That also I have given here. Reverse mortgage means senior citizen can mortgage their house to a scheduled bank housing finance company. In class, I take example of a very old man called Jollu Tata. That Jollu Tata is there. No, he is very, very old and he is having a house, but he is not having the money to take care of himself. So what he will do, you know, this house that he is having, he will give to the bank as mortgage, and instead the bank will give him a loan. This loan can be in monthly installment also, it can be in quarterly installment also, and it can be in a lump sum amount also. For a period of up to 20 years, the Jollu Tata will get the loan. Then the Jollu Tata can use this money to take care of his expenses. He can have food, he can live peacefully, comfortably, because he is having the money from the bank. Later on, let's say the Jollu Tata died. In that case, what will the bank do? The bank will now go to the legal heir of Jollu Tata and they will tell that you please return us the money along with interest and you take your house back. But if the legal heir are not able to give the money, then the bank will take this property, they will sell the property, and whatever amount they have received on sale, no, with that they will first repay their own loan and balance money they will give to the legal heirs. So this type of transaction is called reverse mortgage transaction. So, in senior citizen can mortgage their house to a scheduled bank or housing finance company. In return, the bank gives them a lump sum loan, regular monthly or quarterly or annual installment loan up to 60% of the value of the house. The above amount cannot be used for speculation or trading. So the Tata is there, no, he can't do gambling with this house. He can't do speculation, he can't do trading. Okay, maximum loan is for 20 years. After death of the borrower, bank gives the option to the legal heir to repay the loan and get the house back. Else, it is sold to recover the loan along with interest, and balance amount is given back to the legal heirs. And you know what? I told you already, when Tata is giving house to the bank, in case of reverse mortgage, it is a transaction not regarded as transfer. So Tata need not pay any capital gain. Similarly, when the bank is giving the money to the Tata or legal heirs, in that case also, it is not regarded as, it is totally exempt under section 10 clause 43. So the amount received by the senior citizen as the loan, either in lump sum or the installments, in a transaction of reverse mortgage is completely exempt from income tax. So Tata need not pay any tax on both ends. Okay, so when the house is going, that time also not taxable. When money is coming, that is also not taxable. Now last point, transfer of assets by a company during liquidation. So the company itself is liquidating or closing down. So while closing down, whatever assets are belonging to the company, no, it will distribute to its shareholders. In such case, when it's transferring the assets during liquidation, it is a transaction not regarded as transfer. The company need not pay any capital gain tax. Okay, so these are all the transactions not regarded as transfer. So with this, your charging section is complete. I hope you are thorough with the charging section. Now let us come to computation of capital gain. Computation of capital gain is given under section 48, and there is a format, Kanna. You have to follow this format only in the examination so that you can score full marks, and the same wordings only you have to use. You can't use any other wording. So what is the format? So first you have to take full value of consideration. This full value of consideration is nothing but selling price. Okay, generally it is the selling price of the capital asset. That is only full value of consideration. Sometimes it can be insurance claim value also. Sometimes it can be the fair market value of capital asset also. Sometimes it can be the value given by the government in case of compulsory acquisition also. So that is all full value of consideration. It can be different in different cases. When you see the cases, you yourself will be able to apply, Kanna. Not to worry about. Generally, full value of consideration means selling price. So from the selling price, you can reduce transfer expenses. What are transfer expenses? Transfer expense means to make the sale happen, you would have incurred some expense. For example, you want to sell your house. So to sell your house, you went to a broker, and to the broker you are giving brokerage. That is a transfer expense. Similarly, to sell your asset, you gave advertisement in newspaper. So that is also a transfer expense. So these are all transfer expenses. This you can reduce, but be careful. You cannot reduce STT and CTT. That is security transaction tax and commodity transaction tax. In PGBP, that is profit and gains of business or profession, you can reduce STT and CTT, but in capital gains, you cannot reduce STT and CTT. Fine. So STT and CTT are not transfer expenses. Other than that, whatever expense you incur to make the sale happen will be called transfer expense that you can reduce. So balance amount will be called what? It will be called net consideration. Net consideration. From the net consideration, you can further reduce cost of acquisition and cost of improvement. Cost of acquisition and cost of improvement, and finally you will get capital gain. This capital gain, or it can be capital loss also. This capital gain or capital loss will be either short term or long term, depending on period of holding. That I am going to discuss now in a few minutes. Then finally, there are some exemptions which are given in section 54 series. So if at all this exemption is valid, then that exemption amount also can be reduced. The balance amount will be the taxable capital gain or taxable capital loss. You get my point? So now what is how to compute capital gain? First take full value of consideration. From that you reduce transfer expense, you will get net consideration. From net consideration you reduce cost of acquisition or cost of improvement, you will get short term or long term capital gain or capital loss. From that you can further reduce section 54 series exemption, and you will get the taxable capital gain or capital loss, which can be long term also, which can be short term also. So now you know how to calculate capital gains. Computation table is very simple, Kanna. You know what is difficult? The difficult part is what figure you should write in the respective columns. There will be at least 3 or 4 amounts given in the question. You have to analyze and you have to decide which amount you have to pick, and you have to write in the exam answer sheet that what is the reason behind picking that amount. That is only the beauty of capital gain chapter. Okay, wow. This calculation and all is very simple. Now let us see firstly the difference between short term capital gain and long term capital gain. That is based on the period of holding concept, Kanna. So what is this period of holding concept? Period of holding concept means very simple. The date of acquisition till the date of transfer is called period of holding. So when you purchase the asset, from that date till the date of sale of asset will be considered as period of holding. This period of holding can be short term also, it can be long term also. If period of holding is short term, then the asset is considered as short term capital asset. If period of holding is long term, then the asset is considered as long term capital asset. So there are two categories, 12-month category and 24-month category. Some assets are covered in 12-month category, all the remaining assets are covered in 24-month category. So what are the assets? Let us see. So number 1, in 12-month category we are seeing securities listed in a stock exchange. So all securities, shares, debenture or any security that is listed in a recognized stock exchange. Then unit of a equity oriented fund or UTI. UTI means Unit Trust of India. Okay, so unit of equity oriented fund or UTI. And third one, zero coupon bonds. So what did I say? Security listed in a stock exchange, unit of equity oriented fund or UTI, and zero coupon bonds. These 3 assets alone, you have to see that if it is held up to 12 months, it is short term. If it is held for more than 12 months, it will be considered as long term capital asset. All the other assets will come under 24-month category. So jewelry means 24-month category, land and building means 24-month category. All the other capital asset come under 24-month category. Fine. So this is period of holding concept. However, there are 3 exceptions. I am not discussing them now. In that section, I will discuss that it is an exception to period of holding. Okay, wow. Moreover, one small point alone I would like to say that if at all land and building are sold together, in which land is long-term capital asset and building is short-term, can it be possible that first I bought a land, sir, that I bought 5 years back, but building I have constructed only 6 months back and now I am selling. In this case, what will happen? Building is short-term, land is long-term. In such case, how to calculate capital gain? Here you have to split it into 2 parts, Kanna. For building, you have to calculate long-term capital gain separately. Short-term capital gain separately, and for land you have to calculate long-term capital gain separately. So like that you will do the working. Now let us talk about period of holding in special cases. So period of holding in special cases we will discuss along with section 49, cost of acquisition. Fine. So now you know how to differentiate between short-term and long-term. Short-term capital asset means the gain will be short-term capital gain or capital loss. Similarly, long-term capital asset means the capital gain or capital loss will be long-term capital gain or long-term capital loss. You get my point? Now let us come to full value of consideration. So full value of consideration, for now you just know it is the selling price. Whatever amount you are receiving on the transfer of capital asset is called full value of consideration. However, other cases we will be discussing in that situation. Fine. So this is full value of consideration. Transfer expenses also I have already told you. Now what is the next part? That is cost of acquisition. So cost of acquisition, let me tell you. What is cost of acquisition, Kanna? Cost of acquisition means the consideration paid to acquire the capital asset, which is nothing but purchase price. So what amount you are paying to acquire the capital asset is called cost of acquisition. But is it so simple? Answer is no. It is a detailed discussion. For next 15-20 minutes, we are going to discuss cost of acquisition only. Firstly, let me tell you about the capital gain which was happening before 23/7/2024. Okay, wow. Kanna, 23/7/2024 means what? Previous year 24/25. But for your exams, what previous year is applicable? Previous year 25/26 is only applicable. However, there is a date called 23/7/2024 which was there in previous year 24/25. Before that, the tax rate was different. On or after 23/7/2024, the tax rate has changed. But should you learn the old tax rate also? Answer is yes. You have to learn the old tax rate also, old provisions also, because in your question, there can be a situation where a transfer has happened before 23/7/2024. In that case, you have to calculate in the old method with the old tax rate and you should be able to answer. So firstly, let me talk about what was the position before 23/7/2024. Then I will talk about on or after 23/7/2024 what has changed. Okay, wow. So firstly, before 23/7/2024, long-term capital gain was taxed at 20%. So the rate of tax was 20% with indexation. Sir, what is this indexation? New concept you are telling us. So long-term capital gain tax was 20%. So tax rate is 20% with indexation. Now let me tell you about indexation. Listen here, Kanna. Firstly, if at all you have bought a asset. Okay, wow. This asset you had bought 10 years back. 10 years back, let's say its price is 1 crore. This asset now you are selling for 10 crore rupees in previous year 25/26. Okay, in previous year 25/26 you are selling for 10 crores. Fine, after 10 years you are selling. Now in 10 years, no Kanna, this asset value is there, no. First the cost is how much? 1 crore. The selling price is how much? 10 crores. So what is profit? The profit, or you can tell capital gain, is equal to 9 crores. Am I right? Capital gain is 9 crores. In this 9 crores of capital gain, now listen carefully, I am talking about a concept. It can be because of two reasons, Kanna. This capital gain can be because of two reasons. First reason is because of the decrease in value of money, and second reason is because of the increase in value of asset. Very, very important. Because of decrease in money value, over a period of time, the money value comes down, because of which everything becomes expensive. Okay, wow. So 50 years back, if you are buying rice or 1 kg of fruit, you can buy for 1 rupee. But now if you are buying 1 kg, you are buying for 200 rupees or 250 rupees. Okay, wow. So that is why the money value has come down. Similarly, for all the assets, generally the value of money has come down. That is why all the asset price keeping on increasing. Okay, so due to decrease in the value of money, this concept is only called inflation. Inflation. Fine. And second reason is due to increase in the asset value. If the asset value goes up also, you will get a profit. So if money value comes down, then also asset value will increase. And if asset value increases, then also generally asset value will increase. So both cases asset value will increase. Now what did the government say earlier, before 23/7/2024, before that, the government told we are only going to tax the increase in asset value, because this is only actual profit. But whenever you are getting a capital gain because of the decrease in money value, it is called inflation. It is not your real profit, Kanna. It is only decrease in the value of money. So why to tax it? That is why the government will only tax increase in the asset value. That is why the government told that we will remove this inflation from the capital gain. Balance capital gain alone, you give us the tax at 20%. 20% on the balance capital gain. Now the question comes, sir, how will you remove this inflation from the asset price? Answer is using indexation. So you should remove the inflation using indexation. Now what is this indexation? Indexation concept is very simple. The government will give index numbers. Index numbers. This index number is there. No, it has started from 1/4/2001, and the first index which was for 2001-2002, it was how much, 100. So the first index number was 100. Like that, for every year the government will keep on giving index number. Sir, should I memorize index number? Answer is no, Kanna. You just know that the index number for 2001-2002 was 100, and for your previous year, that is previous year 25-26, it is 376. That much it is enough. All the balance index number will be given in the question itself. Fine. So 100, 105, 110, 112, like that the government kept on increasing, and previous year 25-26, now the index value is 376. You know what it means? It means that in 2001-2002, if you had 100 rupees, okay, in today's terms, its value should be 376 rupees. Or if you are having an asset whose value is 100 rupees, today due to inflation, the value of that asset should be 376 rupees. So that is only concept of index number. So now what you should do, you should take the cost of your asset and you have to index your cost. It means what? Increase the value of your cost to remove the inflation, But before that, I want to tell you one more point. Kanna, this index number, it started from 1/4/2001 only. What if the asset was purchased before 1/4/2001? Let's say I purchased an asset in 1980. Then how to do the indexation? Very, very difficult, no? Because from 1980 up to 1/4/2001, I am not having any index number at all. So how to bring the value of the asset which was there in 1980 to 1/4/2001? How to bring the value to 1/4/2001? That is the question. Because from 1/4/2001, I can use indexation to remove the inflation. But up to 1/4/2001, what to do? That is why the Income Tax Act has given a benefit to the assessee, that the assessee can take the fair market value as on 1/4/2001 as the cost of acquisition. So let's say if your purchase price in 1980 was 1 crore, but on 1/4/2001 this value became 3.5 crores, then obviously 3.5 crores is beneficial for you. If you are having a higher cost, it means you will have lesser capital gain. So definitely you will take the benefit, and now your cost will become how much? 3.5 crores. Now this 3.5 crores onwards, you will start doing inflation. So 3.5 crores, you will divide by index number, that is 100, multiplied by current year index number, that is 376. And then you will find what is the indexed cost of acquisition. Then while calculating the capital gain, we reduce the cost of acquisition? No. Instead of that, you will reduce indexed cost of acquisition and calculate capital gain. So this was the method being followed. However, when it came to land and building, now let me come to the point. When it came to land and building, people were misusing this section. Okay, well, what did I tell? When it came to land and building, people were misusing the section, because if you take higher cost as fair market value as higher value, then obviously your cost will also become higher, so your capital gain will come down. So when it came to land and building, people used to go to valuers and they will give some good fees, and the valuer will give high fair market value as on 1/4/2001 for this land and building, because of which the cost will increase and capital gain will come down, and the people will not pay any tax at all. So to avoid this, what did the government do? The government told, okay, you can take the benefit as on 1/4/2001, no problem. But this fair market value as on 1/4/2001, should not be more than stamp duty value as on 1/4/2001. So maximum how much you can take? Stamp duty value as on 1/4/2001 only you can take. Fine. Now see the formula. So if at all you are having a land or building or both, Then if it is purchased before 1/4/2001, then what you have to do, take the fair market value as on 1/4/2001 or stamp duty value as on 1/4/2001, whichever is lower. Basically what you are doing, you are restricting the fair market value to the stamp duty value. Maximum fair market value should only be up to stamp duty value. That is why fair market value or stamp duty value, whichever is lower, this lower amount or purchase price. If your actual purchase price itself is high, then why to even get bothered about 1/4/2001 value? Then you will take actual purchase price. That is why the lower value or actual purchase price, whichever is higher, will give you the cost of acquisition. So you get my point? How to find out the cost, Kanna? So whatever is the purchase price, you have to see. First, you see whether the asset is purchased before 1/4/2001. If asset is purchased before 1/4/2001, you can take purchase price or fair market value, whichever is higher. But if the asset is a land or building or both, then you have to see fair market value or stamp duty value as on 1/4/2001, whichever is lower. The lower value or purchase price, whichever is higher, will give you the cost of acquisition of the land or building or both. So I'll give you an example. So let's say a land or building was purchased on 1987 for 10 lakh rupees. On 1/4/2001, the fair market value was 23 lakhs. So now you will be very happy now. On 1/4/2001, now you can take this value as your cost because it is a higher value than purchase price. But the stamp duty value was 21 lakhs only. That is why you have to restrict this 23 lakhs up to 21 lakhs. So maximum you can take 21 lakhs only. So 23 lakhs or 21 lakhs, whichever is lower, or actual purchase price, whichever is higher. So that is why you take 21 lakhs as the cost of acquisition. Fine. Then let's talk about improvement. Kanna, what is improvement? Improvement means the capital expenditure incurred on the capital asset. That is only improvement. However, improvement does not include any revenue expenditure. Also, for any expenditure, if you have already claimed a deduction, that is also not included in improvement. So improvement means capital expenditure, not revenue expenditure. And if you have already taken deduction, then don't include it in improvement. So let's say in this example, on 25/2/2025, additional floor was constructed on this building for a value of 5 lakhs. So this is also a capital expenditure. Hence, I can call this 5 lakhs as improvement. If at all you are doing indexation for a capital asset, then indexation should be done for the cost also, indexation should be done for improvement also. But sir, in this example that you have given us, improvement has been taken place only on 25 February 2025. Which is less than 24 months. It means improvement is short term. Still, should we do indexation for improvement? Answer is yes. You have to do indexation for improvement also. So do indexation for improvement because the asset is long term capital asset. No, kana. If asset is long term, you have to do indexation. This I am telling you now only. If the asset is long term, you have to do indexation. But if asset is short term, you should not do indexation. Okay, so if asset is long term, we are doing indexation. However, if asset is long term but improvement is short term, then also you should do indexation because it is very simple. Asset long term means you do indexation. Okay, so here also I am doing indexation. So here indexed cost of acquisition is 21 lakhs divided by 100 multiplied by 376. So you will get 78,96,000. Similarly, for improvement, you have to divide 5 lakhs divided by, in the year of improvement, what was the index number you have to see. So it was 363 for 24/25. Then multiplied by 376, you will get 5,79,000. Now both these amount you have to reduce against the cost and you will find out the real capital gain. This capital gain used to be taxed at 20% Kanna. However, from 23/7/2024 onwards, you know what happened? From 23/7/2024 onwards, from this date onwards, the government told, we will not give you the benefit of indexation. We will not give you the benefit of indexation. Now indexation is over. Okay, then what? But the tax rate is 20. No, since they are not giving the benefit of indexation, they have reduced the tax rate to 12.5%. Okay. So now there is no concept that you should not pay on inflation, you should only pay on the increase in value of asset. Like that, there is no concept. There is only one concept. You do selling price minus cost of acquisition is equal to capital gain. On this capital gain, you pay 12.5% tax. It is as simple as that. There is no concept of indexation. Okay, but in one place, no, concept of indexation still will be coming, that I will be telling you at the end of this lecture. Okay, so that is why only we are learning all this. There are two reasons to learn the before provision karna. First reason is that they can give you a before date of transfer and ask you to calculate the capital gain. That also you should be ready. And also on or after 23/7/2024 also, in one case still while finding out the tax you have to do indexation. So you should be knowing how to do indexation. Okay, so this was the concept of indexation. So before 23/7/2024, the cost of acquisition and cost of improvement have to be indexed to find out the indexed cost of acquisition and indexed cost of improvement. This only you have to reduce from the net consideration to find out the capital gain or capital loss, as the case may be. Fine. Now let me tell you about the last point about cost of improvement. Kanna, if cost of improvement, if it was occurred before 1/4/2001, then you have to ignore that cost of improvement. Don't consider it. Why, sir? Why not to consider it? Because as on 1/4/2001, you are taking the fair market value, no? In that fair market value, already that improvement would have been included. That is why you have to ignore any improvement done before 1/4/2001. You know what, Kanna? This improvement, this 1/4/2001 concept itself, why was it introduced? It was introduced because from 1/4/2001 only you are having index number, correct? But before that you are not having index number. That is why you have the option to take the fair market value as on 1/4/2001. But now that is on or after 23/7/2024, indexation itself is removed. So if you speak logically, should you have any benefit as on 1/4/2001? Answer is no. But still the Income Tax Act, even though there is no indexation concept now, but still the Income Tax Act is giving you the benefit that you can take the fair market value as on 1/4/2001 as your cost of acquisition. Fine. So that is why even though there is no indexation now, still if the asset was purchased before 1/4/2001, the assessee can take the fair market value as on 1/4/2001 as the cost of acquisition. And if at all it is a land or building or both, then this fair market value will be restricted to the stamp duty value. So let us read this quickly. Cost of acquisition means consideration paid to acquire the capital asset. It also includes the expenses incurred for completing the title. For example, when you buy the house, you are also paying the stamp duty. So can you increase the value of the house by stamp duty value? Answer is yes. You can include stamp duty also in the cost. If the capital asset becomes a property of the assessee before 1/4/2001, then the cost of the acquisition shall be the actual cost of acquisition or fair market value as on 1/4/2001, whichever is higher. Fine. However, in case of land or building or both, the fair market value as on 1/4/2001 should be restricted to the stamp duty value as on 1/4/2001. This also I told you. And lastly, in case of land or building, cost of acquisition does not include the deductions claimed under section 24B or chapter 6A. So for any amount, if you have already claimed the amount as deduction, that amount you should not include in the cost. For example, for interest on housing loan, you are claiming deduction under house property chapter. For stamp duty or repayment of housing loan, you are claiming the deduction under 80C, that is deduction under chapter 6A. So all those amounts which you have already claimed as deduction, that you should not include it in the cost. Okay, then cost of improvement. Cost of improvement means capital expenditure incurred on the capital asset. So whatever capital expenditure is there, capital, and then if any cost of improvement is before 1/4/2001, it should be ignored. Okay, so don't take whatever cost of improvement in any case. If it is given before 1/4/2001, you should ignore it. Okay, so this is the concept of cost of acquisition. General concept we have learnt, Kana. Now let us see cost of acquisition and improvement in special cases. Firstly, let us talk about intangible asset. In intangible asset means what? An asset which you cannot touch and feel, like patent, copyright, goodwill, trademark, etc. And here other examples are also there. That is copyright, trademark, patent, license, tenancy rights, stage carriage permit. So what is stage carriage permit? The permit will be there, no? Like for example, if a truck is moving to different states, it will get an all India permit or a state permit. So that is only stage carriage permits. Then loom hours. So for handloom, number of hours will be specified for a particular person. That is only loom hours. So all these are intangible assets. So these intangible assets are there, no? Here the first point is that you cannot take the benefit of fair market value as on 1/4/2001. So if the intangible asset existed before 1/4/2001, you cannot take the fair market value of 1/4/2001 as the cost. That benefit is not there for intangible assets. Then if intangible asset is generated by self, okay, for example, I am having the asset and I have only created that asset. In such case, cost will be taken as 0. Self-generated asset, cost is taken as 0. If I have purchased the intangible asset, let's say I have purchased the goodwill or I have purchased the patent, in such case, the cost of asset will be the purchase cost. Purchase cost. Then in any other case, it can be the cost of previous owner. Okay, well, for example, my father was having a patent. Now he has gifted that patent to me. Now what will be the cost of this patent? It will be my father's cost. Previous owner cost will be the cost of acquisition. Then cost of improvement should always be taken as 0. So cost of acquisition in case of self-generation is 0. In case of purchase is purchase cost. In any other case, it should be taken as cost of previous owner. Cost of improvement is always 0. And fair market value as on 1/4/2001 benefit is also not allowed for intangible assets. You get my point? Now one point about goodwill. Goodwill, no, it was earlier considered a depreciable asset till previous year 1920. Till previous year 1920 it was a depreciable asset, but after 1/4/2020 onwards it is not a depreciable asset. You cannot claim depreciation. That is why if at all the goodwill was existing before 1/4/2020 and if you have claimed the depreciation on goodwill, then whatever is the closing WDV as on 31/3/2020, this only will become your cost of acquisition. Cost of acquisition. So don't take the purchase price. You would have claimed some depreciation, no? So that depreciation should be reduced. So as on 31/3/20, what is the closing balance? That only will be considered as cost. So that only I have written it. In such case, cost is equal to purchase cost minus depreciation claimed. Fine. Now let's talk about financial assets. Financial asset. Firstly, shares. In case of shares, what is the cost of acquisition? Cost of acquisition is purchase cost. So for what value you are buying the shares, that is only cost. Then period of holding. From when will the period of holding start? The period of holding will start from the date of allotment of shares onwards. So when you buy, that date is not considered as starting date. The starting date will be the date on which the shares are allotted to you. Okay. Second one, rights exercised, right renounced and right acquired. So let me talk about right shares. Let me give you an example. Let's say Reliance is a company. The market value of the shares of Reliance is 1,500 rupees per share. Now Reliance wants some more money from the shareholders so that it can expand its business. So it will get money and it will issue the new shares. But if it issuing new shares, the old shareholders will get dissatisfied or they will get angry and sad. You know why? Because the old shareholders' value will come down. That is why the old shareholders expect that whenever Reliance company is issuing new shares, then you should first ask the old shareholders. This concept is only called right. Okay, wow. So what Reliance will do? Reliance wants to get money and it wants to issue the shares. So first it will go to old shareholders and it will give them the right. In my example, let's say there is a person called Mr. X. Mr. X is an old shareholder of Reliance. Okay, wow. Now Mr. X is getting a right from Reliance, right? That Mr. X can purchase the shares of Reliance at just 1,200 rupees. So pay 1,200 rupees and get the new shares of Reliance. Market value is 1,500, but the old shareholders are there, they will get at a beneficial price. So they are getting at just 1,200 rupees. So now what Mr. X will do? Mr. X will see, okay, it is a very good offer for me. I will take whatever money I am having, I will give to Reliance and I will get the shares at just 1,200 rupees per share. Very, very beneficial. But sir, what if Mr. X is not having the money? If Mr. X is not having the money, then what will happen? Then in such case, Mr. X, just like that, they can't let go of the right, no. So Mr. X will transfer the rights to another person who is interested to buy the rights. Let's say in my second example, there is another person called Mr. Y. Mr. Y is interested to buy the rights because here he is getting the shares at only 1200, but if he is buying from the market, he will get at 1500. So what will Mr. Y do? Mr. Y will purchase the rights. But will Mr. X sell the rights just like that? Answer is no. He will charge some money. So Mr. X tells that you take my rights to buy the Reliance company shares. I am selling these rights to you for 200 rupees. For 200 rupees per right. Now Mr. Y will buy for 200 rupees, and then after getting the rights, now the rights will belong to whom? It will belong to Mr. Y. Now Mr. Y will pay 1200 rupees to Reliance and get the shares. So in the first example, Mr. X example, how much did Mr. X pay? 1200. So cost of acquisition for Mr. X is how much? 1200. Now in second example about Mr. Y, let us talk about Mr. Y. How much Mr. Y paid? Mr. Y paid 200 for purchasing the rights. Then Mr. Y paid 1200 rupees for purchasing the shares of Reliance. So in this case, total how much? 1200 plus 200 rupees. So 1400 rupees has been paid by Mr. Y. So this is the cost of acquisition of shares for Mr. Y. Okay, wow. So now let us see. Firstly, right exercised. So right exercised means what? Mr. X itself has exercised the right. So in this case, amount paid to the company will be the cost of acquisition. So in our example, it is 1200 rupees paid to the company. Fine. And period of holding, as I told you, will start from the date of allotment of shares. Then right renounced. So what is right renounced? Right renounced means Mr. X is giving his right to Mr. Y. That is only renouncing of the right. In such case, what is the cost of acquisition? Cost of acquisition is 0. Because did Mr. X pay anything to Reliance to get this right? Answer is no. Reliance has given the right free of cost only. That is why the cost of the right will be taken as 0. Sir, what will be the full value of consideration, sir? Full value of consideration will be 200. For this right renouncement, full value of consideration will be 200. Cost of acquisition will be 0. So capital gain will be 200. And generally it is always short-term capital gain because only few days are given by Reliance. So all this transaction happen within a span of 1 or 2 months itself. Okay. So the cost is 0, and period of holding is from the date of offer, that is when the date when the Reliance gave offer, till the date of renouncement, till the date on which it was renounced to Mr. Y. Then right acquired. Right acquired means what? Mr. Y has bought the rights from Mr. X. In such case, what is his cost of acquisition, sir? Cost of acquisition means amount paid to the company, which is 1200 rupees, plus amount paid to the right seller, that is 200 rupees. So total 400 rupees. 1400 rupees. That is the total cost. And here also period of holding will be starting from the date of allotment. Next one, bonus shares. Now let's talk about bonus shares. Bonus shares means what? Shares which are given free of cost. Let's say I am having 5 shares. Company issued a bonus of 1:5. So for 5 shares, I will be receiving 1 share. This 1 share is received free of cost. So generally, what is the value of bonus shares? Cost price of bonus shares? It is 0 because I did not pay any money to get the bonus shares. However, if the bonus shares were received before 1/4/2001, then you can take the fair market value as on 1/4/2001 as the cost of acquisition, because I have already discussed it with you. And what about any shares issued before 1/2/2018? In such case, let us have a discussion in section 112A, when I will be telling about grandfathering. No, I will be explaining this. And for bonus shares also, period of holding will start from the date of allotment. Fine. So now we have discussed the financial assets. Now let us jump to cost of acquisition and period of holding in special cases. Kanna, here in my book, the entire concept is explained in a very different manner when you compare it with the other faculty books or with your study material. You know why? Because here I see that the students are generally rote learning, okay, by hearting, trying to memorize all the different cases. Whereas if you just apply 2 or 3 simple concepts, you are able to identify what is the cost of acquisition, what is the period of holding, and also about the indexation just by seeing the situation. That is why I am not going to explain every case by case. Instead, I am going to tell you about the concept. Then I will tell you in what and all cases this concept is going to apply, so that just by using that concept, you can easily find out the cost, period of holding and indexation. You get my point? So this is completely different. This you will not find anywhere else. You will find only in my book and only in this revision lecture. Fine. So let me tell you. First concept Kanna. If assessee has received an asset free of cost, okay, and the assessee pays no tax for it, in such case, the cost of acquisition shall be taken as the cost from previous owner. Listen Kanna, now you link with the section 47 that I taught you in the beginning of this video, that is transaction not regarded as transfer. Transaction not regarded as transfer. There what did I tell you? Whenever these transactions are happening that are not regarded as transfer, the Income Tax Act will close its eyes. So let's say there is a capital asset, okay, this capital asset was gifted by a father to a son, okay, and then later on it was sold by the son. So first father gave to a son as gift. He did not pay, take any amount from the son. It was given as gift. So already I told you, if any asset is transferred as gift, then it is a transaction not regarded as transfer. So capital gain will not apply. So in this case, what will happen? Whenever this type of transaction is happening, the Income Tax Act will close its eyes. So it means what? As per the Income Tax Act, nothing has happened here. It will see the transaction only from father to sold by son directly. It will not see the transaction which has happened in between, that is the transaction of gift. Fine. That is why this father who is considered as previous owner, the cost of acquisition will be taken from previous owner itself. From previous owner itself you take the cost of acquisition. Then what about period of holding? What is the period of holding? Generally it is from purchase date to the sale date. So date of acquisition till the date of transfer. When did the son acquire? The son had acquired the asset in between when the father gave to the son. However, I told you no, the Income Tax Act has now closed its eyes. That is why this transaction itself it cannot see. That is why period of holding also will start from father to selling by son. So this entire period will be considered as period of holding. To decide whether it is long term or short term, you should know what is period of holding, no? So you have to take it from the previous owner itself. Period of holding, take it from the previous owner. Now what about indexation? Kanna, if the asset is transferred before 23/7/2024 or if the asset is transferred on or after 23/7/2024 in special cases, then you should be applying indexation also. In case of indexation, how to find out what is the indexation? From where should you take the indexation? Answer is you should take the indexation from the previous owner itself as per Manjula J. Shah case. Manjula J. Shah case. Because Income Tax Act says take the indexation from the date on which the son got the asset. Okay, from current owner only you have to take indexation, but it is illogical. Let me not go into the depth why it is illogical. That is why indexation you have to take from previous owner itself. See Kanna, cost you are taking from previous owner, period of holding also you are taking from previous owner, then why to take indexation from current owner? So that is not logical. This case was fought by Manjula J. Shah and she won in the Bombay High Court. That is why that case law reference you are taking, and indexation also you should take from previous owner itself. So in your examination, whenever you are getting a chance to find out indexation and you are taking the previous owner value, in such case you have to mention that as per Manjula J. Shah you are taking indexation from previous owner. Indexation from previous owner. So what did I say? If the asset is received free of cost, so here the son is receiving free of cost and the father does not pay and the son does not pay any tax. Okay, in that case the Income Tax Act will close its eyes. It is considered as transaction not regarded as transfer. That is why you should take previous owner cost. From previous owner itself period of holding will start. From previous owner itself indexation also will start. Okay. Now, so in what and all cases this concept will apply, let me tell you. Firstly, distribution of assets on the total or partial partition of HUF. So when HUF is partitioning the property, then HUF need not pay any tax. It is a transaction not regarded as transfer. When the individual are receiving the property, at that time they are also not paying any tax. That is why you have to take the cost of previous owner, indexation from previous owner, period of holding from previous owner. Then gift or will by an individual or an HUF. Let's say the individual is getting a gift. In that case, if at all it is taxable, then this is not applicable. If the gift is received and no tax is being paid on it, in that case the cost will be taken from previous owner, period of holding also from previous owner. Then succession or inheritance or devolution. So even if an asset is received in succession, then take cost from previous owner, period of holding from previous owner. Then transfer due to revocable or irrevocable trust. Transfer to revocable or irrevocable trust. So when a person is transferring to a revocable or irrevocable trust, okay, revocable means temporary transfer, irrevocable means permanent transfer. Whenever the trust is receiving it, in that case cost will be taken from previous owner, in period of holding also from previous owner. Then when holding company is giving to Indian subsidiary company, then also I told no, Income Tax Act will close its eyes. That is why the cost of acquisition will be taken as what was the cost of the holding company. Period of holding also will be taken from holding company itself. Then subsidiary to Indian holding. When subsidiary is transferring to holding also, it was purchased by subsidiary, but it is transferred to holding. No. When the transfer was taking place, the Income Tax Act closed its eyes. That is why it is a transaction not regarded as transfer. So in future, when the Indian holding company is selling the asset, in such case, take the cost of acquisition from the subsidiary itself. Take the period of holding also from the subsidiary itself. Next one, when amalgamating company is transferring to amalgamated. So for example I gave you, let's say PVR is transferring to new company, that is PVR Inox. In such case, what will happen when the transfer is taking place? The Income Tax Act will close its eyes. That is why when PVR is transferring asset to PVR Inox, later on when PVR Inox is selling the asset sold, then what you will do? The cost of acquisition you have to take. What was the cost to purchase? Cost for PVR, whatever was the cost you have to take, and period of holding also, entire period you have to take from PVR to the sale of asset. The entire period you have to take. Similarly, demerged company to Indian resulting company. So when old Reliance is transferring to Geo Finance, then also this will apply. Then conversion of an individual property into HUF property also, this concept will apply. So in all these cases, cost of acquisition from previous owner, period of holding from previous owner, and if at all indexation is applicable, take indexation also from previous owner itself, but make sure that you mention Manjula J. Shah. Okay. Now let's come to cost of improvement. Cost of improvement also you have to take from previous owner, but I already told you, if the cost of improvement was incurred before 1/4/2001, you have to ignore such cost of improvement. Next one, concept number 2. Old asset is converted into new asset, sir, and this conversion was not regarded as transfer. So old asset being converted to new asset. Let me give you an example. Let's say amalgamating company shares converted to amalgamated company shares. So in this PVR Inox itself, let's say there was a shareholder of PVR. He was having PVR shares. Now his PVR shares got cancelled and converted to PVR Inox shares. So now his new shares is PVR Inox. And I already told you in the first part of this video that whenever this type of conversion is happening, the Income Tax Act will close its eyes. That is why whenever in future you are selling the PVR Inox shares, at that time what will be the cost? What will be the cost? Cost of acquisition shall be the cost of PVR shares. So cost of old shares only should be taken as the cost, because here the Income Tax Act has closed its eyes. That is why you should take from the previous transaction itself. So take cost from the old shares, take period of holding also from the old shares. So now cost of acquisition, cost of old asset, period of holding also from the old asset. Now in what and all cases this applies, let us see. So shares of amalgamating company converted to amalgamated company, then conversion of bond, debenture stock or deposit certificate into shares or debentures. So here also it will apply. Then conversion of equity shares into preference shares, then shares of resulting company to the demerged company, conversion of resulting company to demerged company, then electronic gold receipt to gold to electronic gold receipt. So in all these cases this will will apply. But this resulting company alone you cut it here, because resulting company I have covered in the next concept. Okay, in demerger no kana, the concept is little bit different. Now listen, in demerger I already told you, no, there was a company called Old Reliance. Okay, this Old Reliance has now split into two companies, that is Jio Finance Company and New Reliance Company. So first, let's say this person would have bought Old Reliance shares for ₹1000. Okay, but now he has gotten two different shares. Now he is having one Jio Finance share and he is having one New Reliance share. And I already told you that when this transaction was happening, the Income Tax Act will close its eyes. So it will assume that no transaction has happened. So generally what do? We take it from the old asset. But here you cannot take from old asset. Why? Because how to find out what is the cost of Jio Finance and what is the cost of New Reliance? Earlier you were having only one share. That is for ₹1000 you had purchased. But now that one share has become how many shares? It has become two shares. So what is the cost of both shares? How to find out? For that you have to divide this value of 1000 on proportionate basis, so that you can find out this 1000 how much belongs to Jio Finance shares, how much belongs to New Reliance shares. So that how to find out using the net worth formula. So let me give you the formula. See here, cost of acquisition of Jio Finance shares is equal to cost of the Old Reliance multiplied by book value of the asset transferred to Jio Finance divided by net worth of Old Reliance. So what is the Jio Finance value divided by Old Reliance value, that is the full company value. With that you are able to find out what is the cost of Jio Finance shares. You get my point? Then what about New Reliance shares? Very simple, that 1000 multiplied by Jio Finance shares is equal to New Reliance shares. So cost of Old Reliance minus cost of Jio Finance is equal to cost of New Reliance. So this only I have given here. Cost of acquisition of resulting company is equal to A multiplied by B by C, where A is equal to cost of acquisition of demerged company share, B is equal to net book value of the asset transferred during demerger, and C is the net worth of the demerged company immediately before the demerger. So like that, using this proportionate formula, you have to divide this ₹1000 into two parts. So what is the cost of Jio Finance? What is the cost of New Reliance? Like that you have to split. Period of holding will be taken from the old Reliance itself. So from the old asset itself, you have to take period of holding. Now let's come to concept number 4. Very simple. If the assessee has paid a tax while receiving an asset, then whatever value was considered while paying the tax will be considered as cost of acquisition. So there are few cases here. Let's take example of ESOPs or sweat equity shares. Listen Kanna. This I have discussed in the salary revision video also. Here also once again I am telling you for the purpose of understanding. Let's say the employer is giving the employee shares, that is ESOPs. Okay. The value of the shares, market value is equal to ₹1000. But the employer is giving only for ₹200. So market value is how much? ₹1000. But the employee has paid how much? Only ₹200 to get the shares. Now in salary head of income, what did we learn? We learned that 1000 minus 200 is there. No, that is the fair market value minus exercise price, that is ₹800 will be taxable under the salary head of income. Under salary. So while paying the tax, what did the employee do? The employee has considered the value of the shares as 1000, and on this value he has paid the tax. So what was the value of share considered? ₹1000. Since the value of shares was considered as ₹1000 and tax has already been paid, that is why for future purpose this market value will become the cost of acquisition. So in future, when the employee is selling the shares, let's say in future employee is selling shares. So first we have to take full value of consideration, correct? From this full value of consideration, we have to reduce the cost of acquisition. Here what you will reduce? Will you reduce 200? Answer is no. You will reduce ₹1000 as cost, because already he has considered 1000 and paid the tax. That is why now his cost will become 1000. So in all the cases where if you are paying the tax and while paying the tax you have considered some value of the asset, that value will become your cost. So let us see what are all the cases. Number 1, is the ESOPs, employee stock option plan. Second case, stock in trade converted into capital asset. So whenever stock in trade, that is the stock, is converted into capital asset, then fair market value of the stock is considered as income in PGBP. Fair market value of stock is considered as income in PGBP. You have to pay tax under PGBP when you convert stock into capital asset. Hence, whatever value is considered as fair market value will become as cost of asset for future capital gain calculation. Then property taxed under section 56.210. So 56.210 is the section of gifts that we discuss in income from other sources chapter. Then also we learn that whenever a person is receiving movable property or immovable property without consideration or for inadequate consideration, then it is taxable under 56.210. There, whatever was considered as fair market value, it will be considered as cost of acquisition for future purposes. Okay, so for example, let's say I received a property worth 1 crore rupees free of cost from my friend. So my friend is giving me property of 1 crore. No, I have not paid anything. So for me, practically the cost is zero. But in 56.210, I have to consider the value of 1 crore, and on that 1 crore, I have to calculate my income and pay the tax under income from other sources. That is why the value of the property, that is 1 crore, it will become my cost for future purposes. So in future, whenever I am selling the property, I can reduce the cost as 1 crore. Okay. So property tax under section 56.210, and similarly fair market value of the assets received on liquidation. So whenever you are receiving on liquidation, then also fair market value will be considered as cost of acquisition of the asset. So here cost of acquisition is equal to amount considered as value of the asset while calculating the taxable income. Period of holding should be taken from the time of receiving the asset, and indexation also only for land and building case, that special cases. From the time of receiving the asset, you will calculate the indexation. So period of holding, since you have paid the tax, no, that is why when you receiving the asset itself, start calculating period of holding. Similarly, indexation also will start from the date of receiving the asset. Fine. Here in case of sweat equity, it will start from the date of allotment. In case of stock in trade converted into capital asset, it will start from the date of conversion. Here not allotment, you can change it to conversion. Okay. Then next concept, if previous owner itself cannot be determined. So you have received from owner, but however previous owner value, what was the cost of previous owner, you don't know. When did the previous owner buy, that also you don't know. In that case, what to do? In that case, on the date of receiving the asset, whatever is the fair market value, that you take as the cost of acquisition, and period of holding also will start from that date itself. Fine. Even indexation will start from the date of receiving the asset. So these are the 5 concepts. I hope you are clear. Now let us talk about section 48 proviso 1, special case of non-resident. Okay, special case of non-resident, where non-resident is buying the shares. It is applicable to a non-resident and foreign company also. Not applicable under section 112A. So if a transaction is not covered under 112A, that we are going to discuss at the end of this video, then only this provision will be applicable. That is section 48 proviso 1. Asset should be share or debenture of an Indian company acquired in foreign currency. So Kanna, what does this proviso 1 tell? No, the proviso 1 tells that if there is a non-resident, and if the non-resident has bought shares or debentures of an Indian company in foreign currency, then you know what you should do. You should calculate the capital gain also in foreign currency, and that final capital gain you have to convert it into Indian currency and pay the tax. So what we should do? Calculate the capital gain in foreign currency. So what should be done? Whatever is the full value of consideration, whatever is the cost of acquisition, transfer expense, everything should be converted into foreign currency, foreign currency, foreign currency. Okay, then capital gain also you will get in foreign currency. This capital gain you have to convert into Indian currency. Indian currency. How to convert, sir? See, Kanna, cost of acquisition you have to convert using the average of TTBR and TTSR on the date of acquisition. So on date of acquisition, that is date of purchase, take the telegraphic transfer buying rate or telegraphic transfer selling rate. and do the average of both the amount, and whatever is the average, using that you convert the cost of acquisition into foreign currency. If it is already in foreign currency, no need to convert, but if it is Indian, convert into foreign currency. Then full value of consideration and transfer expense also convert into foreign currency using average of TTBR and TTSR as on the date of transfer. Okay. Then finally, whatever capital gain is there, you convert it into Indian currency using the TTBR on the date of transfer. So this is the method of calculating capital gain in case of non-resident who has purchased the shares or debentures of an Indian company using foreign currency. With this, all the basic concepts of the capital gain chapter are now over. That is, we have discussed in the charging section and the computation section. Now let us jump to discuss all the special concepts in the capital gain chapter, starting with exceptions to capital gain charging section. Kanna, what does the charging section say? The charging section says that there should be a capital asset, it should be transferred, and the capital gain is taxed in the year of transfer. However, there are certain cases where the capital gain is not taxed in the year of transfer, it is taxed in some other later year. So let us see all those cases one by one. So first case is section 45 subsection 1a, insurance claim for damage or destruction of capital asset. So let's say when a capital asset, let's say if it is destroyed in 2023, then when does the transfer take place? In 2023. However, let's say the insurance claim is received in 2026. Hence, in the year in which the insurance claim is received only, the capital gain will be taxable. So when is it applicable? It is applicable to capital asset which is destroyed due to accidental fire, flood, typhoon, hurricane, earthquake, tsunami, riot, civil disturbance, enemy attack or any other natural calamity, and insurance claim is received. It is taxable in the year in which the insurance claim is received. If no claim is received, then no capital gain will arise. In case of long-term capital asset being land or building purchased before 23/7/2024, indexation should be taken only till the date of destruction. Karna. So here, what did I say? Destruction happened in 2023, but insurance claim was received in 2026. So when will you pay the tax? The tax will be paid in 2026 only. However, till the date of destruction only you have to do the indexation. So till 2023 only indexation has to be done. You get my point? So now whenever you are calculating the capital gain, in the computation, while writing the full value of consideration, you have to write whatever is the money or the fair market value of the asset received as insurance claim. Okay, in the full value of consideration, balance calculation will be as usual. So you have to reduce the transfer expense, then you have to reduce whatever is the cost of acquisition or cost of improvement. You will get the short term or long term capital gain or capital loss. You get my point? Now let's come to section 45 subsection 2, conversion of capital asset into stock in trade. So when capital asset is converted into stock in trade, then in the year of conversion only the capital gain will arise, but it will be taxable in the year in which the stock is sold. So transfer arises when the assessee converts the capital asset into stock in trade. However, it is taxable in the year in which such a stock is sold. Moreover, if only part of stock is sold, then only part capital gain will arise in the year in which such part is sold. Let me give you an example. Let's say there is a builder. So what is the work of builder? Work of builder is constructing the building and selling the building. Now this builder had constructed his own building for own use in 2019. 2019 he constructed a building for 100 crores which he was using for own business. However, later on in 2023 he converted this building into stock in trade. So when does the transfer take place? The transfer take place in 2023 when the building is converted into stock. However, what did I say? When is it taxable? It is taxable in the year in which the stock will be sold. So let's say in 2023 it was converted into stock. Later on in 25-26 2 floors of the building were sold, and in 26-27 remaining 2 floors of the building were sold. So that is why in 2023 itself you will calculate the capital gain. Karna. So capital gain will be the fair market value as on the date of transfer. It will be taken as the full value of consideration. Then minus the cost of acquisition 100 crores, it will give you the capital gain. So let's say the capital gain in our case is 150 crores, fair market value 150 crores. Now 2 floors were sold in 25-26 and 2 floors were sold in 26-27. In such case, what will happen? In 2023, you will find out what is the capital gain. So full value of consideration will be taken as 150 crores, which is the fair market value. From this, you will reduce the cost of acquisition, which is 100 crores. So your capital gain will come as 50 crores. Then let's say in 25-26, 2 floors were sold for 100 crores. In 26-27 also balance 2 floors were sold for 100 crores. In such case, take the selling price in PGBP as the sale value. From that you have to reduce the cost to find out the PGBP income. So what should be the cost that should be reduced in PGBP? The cost should be the fair market value which was taken for capital gain purposes. So this fair 150 crores only will become the cost. However, you have sold only 2 crores. So that is why 50% will be taken as the cost in first year. Balance 50% will be taken as cost in second year. So the PGBP income will be 25 crores in year 1 and 25 crores in year 2. Similarly, this capital gain also, although the capital gain had arisen in 2023, but it will be taxed in the year in which the stock is sold. So 50% capital gain will be taxable in 25-26. Balance 50% will be taxable in the year 26-27. You get my point? So this I have given it here also in the form of a table. So whenever there is conversion, you have to take the full value of consideration as the fair market value as on the date of conversion. Period of holding also you have to take only up to the date of conversion. Then indexation also, if at all it is applicable, you have to take on the date of conversion, till the date of conversion. So minus cost of acquisition or index to cost of acquisition, cost of improvement or index cost of improvement, you will get the short term or long term capital gain or capital loss. It will be taxed in the year in which the stock is sold. So when the stock is sold, only capital gain will be taxable. You have to calculate the capital gain when the conversion take place, but you have to tax it in the year in which the stock is sold. Fine. So whenever the stock is sold, the selling price of the stock should be taken minus fair market value should be reduced, then it will give rise to PGBP income. So the year in which the stock is sold, in that year PGBP income will also come, capital gain income will also come. Fine, you get my point? And if at all 54EC exemption will be claimed, then the 6 months period for 54EC exemption will start from the date of sale of stock only. Okay, in 54EC we will see to claim the exemption there is 6 months time from the date of transfer, but here you should not take from the date of transfer, you should calculate the 6 months from the date of sale of stock. Now let's come to stock in trade converted into capital asset. So when stock in trade is converted into capital asset, then in the year of conversion PGBP income will come. However, here there is no benefit Kana. Here there is no benefit. That is why this PGBP income will be taxable in the year of conversion itself. For this PGBP income, you cannot wait till the sale of capital asset to tax it. In the year of conversion itself, it will be taxable. Later on, whenever capital gain is there, in that year, the capital gain will be taxable in the year of sale of capital asset. Fine. Then section 45 subsection 5, compensation on compulsory acquisition. So compulsory acquisition means what? The government is coming and compulsorily acquiring the property and giving the compensation. This will be taxable in the year in which the compensation is received. So when will the transfer takes place? Let's say in 2024 only the government had compulsorily acquired the property. However, the government gave the compensation in 2026. In that case, it will be taxable in the year 2026 and not in the year 2024. Fine. So capital gain is taxable in the year in which the compensation is received by the government. Period of holding and indexation are taken till the date of compulsory acquisition only. So date of compulsory acquisition is only the date of transfer. So period of holding you have to take up to the date of compulsory acquisition. Indexation also, if at all it is applicable, you have to take up to the date of compulsory acquisition. If at all the transferor dies, then compensation shall be taxable in the hands of recipient. So whoever is receiving the compensation will be paying the tax. Later on, then in interest on enhanced compensation, it is taxable under the head income from other sources. Kana, if the government is giving the compensation late, they will also give you some interest. So this interest will be taxable in income from other sources, and there we will also be learning that whatever interest is paid by the government, on this there is 50% standard deduction also allowed in income from other sources chapter. Fine. Now let us talk about compensation being received in installments. Installment means what? The government is giving compensation in multiple installment. Okay, wow. So 50% in first year, balance 30% in second year, 20% in third year. Like that they are giving the compensation. In such case, In case of initial compensation means what? Compensation which is decided by the government. So when the government has decided the compensation and they are giving that compensation, then if at all they are giving an installment, you should not see the installment. Entire value, all the installment combined will be taxable in the year in which the first installment is received. What about enhanced compensation, sir? Firstly, you should know what is enhanced compensation. Enhanced compensation means the assessee is not happy with the compensation fixed by the government. That is why the assessee will go to court to fight against the government. In that case, the court can increase the compensation. So when the court gives the order to increase the compensation, it is called enhanced compensation. Okay, wow. However, sometimes when the court process is running, the court will not give order. In between the case itself, the court will ask the government to pay some enhanced compensation. This is called enhanced compensation due to interim order. Interim order means what? In between the case itself, the court is asking to give compensation. Now, if enhanced compensation is received, then how to tax the enhanced compensation? It is taxed as and when it is received. So whenever enhanced compensation is received, in that year, that much amount is only taxable. Okay, wow. If at all it is received due to interim order, then you have to wait till the final order is passed. In the year of final order is passed, then only it will be taxable. So enhanced compensation is taxable as and when it is received. However, if it is received due to an interim order, you have to wait till the final order is passed. In the year of final order passing only, you have to pay the tax on enhanced compensation. Okay. Now how to calculate capital gain? Firstly, let us talk about initial compensation, which is the compensation given by government. In case of initial compensation, full value of consideration will be taken as initial compensation, and then from that you reduce all the other items as usual. Transfer expense, cost of acquisition, cost of improvement. You will get the long term or short term capital gain or capital loss. Then let's talk about enhanced compensation. Enhanced compensation means what? The court has asked the government to give some extra compensation. That is only called enhanced compensation. In case of enhanced compensation, full value of consideration will be considered as enhanced compensation. And in transfer expense, you can reduce the litigation cost also. Litigation cost means what? Whatever fees you are giving to the lawyer, that you can reduce. Whatever court fees you are paying, that you can reduce. So finally you will get net consideration. But from the net consideration, can you reduce any cost of acquisition? Answer is no, because cost of acquisition you already would have reduced while finding the capital gain on initial compensation. So once again you cannot reduce kana. That is why you can only reduce the transfer expense, and whatever amount will be coming will be long term or short term capital gain or capital loss, as the case may be. Fine. So this was about compensation on compulsory acquisition. One more point I would like to say is about the exemption on compensation of compulsory acquisition. Whenever the government is giving compensation on acquisition of urban agricultural land, that is exempt for individual and HUF if the conditions are satisfied. But sir, what about rural agricultural land? Rural agricultural land is however not taxable because it is not at all a capital asset. That is why only we are speaking only about urban agricultural land. So if the government is compulsorily acquiring urban agricultural land and if they are giving the compensation, then it is exempt if the conditions are satisfied. What are the conditions? The compensation is exempt only for individual or HUF. To other person it is not exempt. Then agricultural land should be used for at least 2 years before the date of transfer by the assessee or his parents or members of the HUF for agriculture purpose. So agricultural land should be used for agriculture purpose for at least 2 years before the date of compulsory acquisition. And lastly, consideration should be determined and approved by the RBI or central government. If these conditions are satisfied, then compensation on urban agricultural land is fully exempt under section 10 clause 37. So this was all the discussion about compulsory acquisition. Now let's talk about liquidation. So the exceptions to charging section are over. Now we are going to all the other special concepts. Firstly, we are discussing about liquidation. Section 46 talks about liquidation. Liquidation means what? The company is closing down. That is why it is distributing whatever asset it is having to the shareholders, and whatever money it is having also it is distributing to the shareholders. Now when the company is distributing to shareholders, when the assets are being transferred from the company to the shareholder, then it is a transaction not regarded as transfer, which we have already learned in the beginning of this video. When the company is giving the asset, it is a transaction not regarded as transfer. Hence, the company need not pay any tax. Fine. Now let's talk about the hands of shareholder. In the hands of shareholder, the assets are coming in and the shares are going out. It means what? The shares are getting relinquished. Fine. Shares are getting relinquished. So what happens when the assets are coming in? What happens on relinquishment of shares? Let us see. Whenever asset and money is coming from the company, then fair market value of the asset up to the extent of accumulated profit, whether capitalized or not, will be considered as deemed dividend under section 2 clause 22C, and it will be taxable under income from other sources. And whatever is the balance fair market value and money received minus deemed dividend, will be considered as full value of consideration for capital gain purposes. Let me give you an example so that you can understand better. Let's say there is a company that company is having a balance sheet XYZ Limited. The company is having balance sheet. In the liability side, you can see that the general reserve is 100 crore rupees, and in the asset side, you can see that the assets are 400 crore rupees. So general reserve means what? General reserve means accumulated profit. Accumulated profit can be general reserve also, profit and loss account also, reserves and surplus account also. So all these are accumulated profit. So this accumulated profit is 100 crores and the assets that are distributed is 400 crores. 400 crores. This 400 crores worth of asset is distributed to all the shareholders. So when the company is distributing this 400 crores asset, will the company pay any tax? Answer is no. It is a transaction not regarded as transfer, so the company will not pay any tax. Now let us talk about shareholder. Let's say there is a shareholder called Mrs. C. Mrs. C was having 100 shares in XYZ Limited, for which she had purchased for 10 rupees per share. Now what happens? She has received assets worth 8,000 rupees from the company. 8,000 rupees from the company. Now listen here. The asset was received for 8,000. Here, the asset of the company distributed was 400 crores. General reserve was 100 crores. So it means what? 1 out of 4, that is 25% of the fair market value is from the accumulated profit. Balance amount or balance asset is not from accumulated profit. So in this 8,000, what did I say? 8,000 multiplied by 100 crores divided by 400 crores. It is equal to 2,000. This 2,000 has come from accumulated profit. Then 8,000 multiplied by 300 divided by 400, that is the balance. It has not come from accumulated profit. Not accumulated profit. So whatever amount has come from accumulated profit, that much amount is deemed as dividend and it will be taxable under income from other sources under section 2 clause 22C. Whatever is the balance amount, so balance amount will be considered as full value of consideration for capital gain purpose. So here full value of consideration will be taken as 6,000 and you can reduce whatever is the cost of acquisition. So her cost of acquisition was 100 shares at 10 rupee per share, which is 300. Hence 5,700 will be capital gain. 5,700 will be capital gain. So this, are you clear? Now let us take one more situation which I have given in red color. Let's say the asset itself was 50 crores. Asset itself was 50 crores. In this case, what will happen? Asset value was 50 crores. General reserve was 100 crores. It means what? All the asset that is fixed 50 crores is entirely from the accumulated profit. Since entire asset is distributed is from the accumulated profit, this red color alone you see, entire value will be treated as deemed dividend. If entire value is treated as deemed dividend, in such case, full value of consideration will be how much? It will be 0. Full value of consideration is 0. Then cost of acquisition you have to reduce 300. That is why this 300 will become capital loss. Capital loss. So in the hands of shareholder, what you should see, fair market value up to accumulated profit will be treated as deemed dividend. Balance amount, whatever is the fair market value balance and money received will be treated as full value of consideration for capital gain purposes. So here for the shares going out, for the assets coming in, let us see, fair market value of asset up to accumulated profit will be considered as deemed dividend under section 222C, taxable under income from other sources. Then when the shares are getting relinquished, then what will be the full value of consideration? Full value of consideration will be total fair market value of asset received plus money received minus deemed dividend that was considered. And from this you reduce the cost of acquisition, you will get the capital gain or capital loss. If entire asset is from the accumulated profit only, in such case entire amount will be deemed dividend under 222C. That is why full value of consideration will be taken as 0 and hence entire cost will be taken as capital loss. Fine. So this is the explanation for liquidation. Period of holding you have to take only up to the date of liquidation karna, and capital gain arises in the year of receipt of asset under liquidation. So whenever assets are received, that year only capital gain will arise. So this was liquidation. Now let us discuss section 46A, which is buyback. Buyback means what? The company shares are there. No, the company is buying back its own shares from the shareholder. Okay, so XYZ company is there, it is buying back its own shares from the shareholder and giving them the money. This is only called buyback. So buyback is very simple. No, generally how to tax the buyback, let us see. So general taxation we will see other than domestic company and other than the other specified assets, that is ESOPs. In that case, what is happening? The company is there, no, company is giving money to shareholder, okay, and shareholder is giving the shares to company, or you can also say the shares are getting relinquished. So in that case, there is a transfer of shares and money is received. That is why this money, whatever is received from the company, will be considered as full value of consideration. Okay, minus cost of acquisition is equal to the cost of purchase of shares, and you will get the capital gain. You will get the capital gain. This is the normal provision, but however, normal provision is only applicable to other than domestic company and specified security. It is not applicable to domestic company. To domestic company, no, you have to learn another method. What is that method? No, illogical method karna. What is the illogical method? The illogical method is that whenever the company is giving the money to the shareholder, in case of domestic company, when the company is giving the money to the shareholder, entire money is treated as deemed dividend under section 2 clause 22F. And you have to pay the tax under income from other sources. It is taxable under income from other sources. But sir, the shares are also relinquished. No, for that what will happen? When the shares are also relinquished, for that you can't do anything. Full value of consideration, nothing you have received, because entire amount you have treated as deemed dividend. So full value of consideration will be considered as 0 minus you will do the cost of acquisition. So balance amount will be capital loss. This capital loss you can do for doing set off and carry forward adjustment. Okay, so in case of domestic company, what happens? Whenever domestic company is giving the money for buyback, entire money, okay, you should not see accumulated profit, nothing. Entire money is treated as deemed dividend under section 2 clause 22F. Okay, and when it comes to the shares, because the shares are relinquished, that is why the full value of consideration will be considered as 0. Cost of acquisition will become capital loss. Cost of acquisition will become capital loss. This can be used for set off or carry forward. Okay, so this is in case of domestic company. So domestic company, illogical method of deemed dividend, but other than domestic company and specified security, logical method of capital gain. Fine, understood both. Now this amount can be used for set off, carry forward. Period of holding is there, no, you have to take from the date of acquisition till the date of buyback. Now let's talk about next case. Section 50 and section 50A, which deal about depreciable asset. Firstly, let us discuss section 50, which talks about WDV method, because for almost all the assessees it is compulsory to opt for WDV method, and it is a block of asset method. Now in WDV method asset calculation, how will the capital gain arise? Let us see. Kanna, whenever you are calculating WDV method, no, first what you will do, first you will see what is the opening WDV of the block. From the opening WDV, you will add what are all the assets that are purchased during the year, that is additions, and then you will reduce what is the money receivable from the assets transferred during the year, which is nothing but sale. So opening WDV plus purchase minus sales, you will get the total. On this total only you will get the you will calculate the depreciation, correct? Now if at all this total is negative, if this total is negative, it means what? The selling price was greater than the addition and opening WDV combined. If the total is negative, then the negative value will be short-term capital gain. You have to include it in the capital gain chapter as short-term capital gain. But if the amount is positive, then you have to see whether any asset is left or no asset is left. If no asset is left in the block, then it will be a short-term capital loss. However, if any asset is left in the block, then you have to calculate the depreciation normally. So what did I say? First you have to do opening WDV plus addition minus sales. Whatever the total you will get, you have to see whether it is a negative amount or positive amount. If it is negative amount, then the amount will be short-term capital gain. But if it is positive, you have to see whether any asset is left or no asset is left. If there is any asset left, then you have to calculate depreciation normally, which I have discussed in the PGBP revision lecture. And if no asset is left, then whatever amount is there, it will be short-term capital loss. You get my point? Now let us come to the point that capital gain is always short term karna. In this case, capital gain is always short term. So this case is an exception to period of holding concept. So period of holding, no, we learned short term and long term, 12 month, 24 month category. This depreciable asset is always considered as short term capital gain or short term capital loss. Fine. However, when we are learning section 54 series exemptions, no, there if at all you want to claim an exemption for long term capital asset, then you have to see whether asset is held for long term. If asset is held for long term, you can still take the benefit of section 54 series exemptions. Fine. Now let's come to section 50A, which speaks about straight line method. If an assessee is engaged in the generation of power or generation and distribution of power, then the assessee can choose straight line method for the assets for depreciation. Now when the straight line method asset is sold, then you have to see whether selling price is lesser than WDV. If selling price is lesser than WDV, then whatever is the difference, no, it will be called as terminal depreciation, and this terminal depreciation is allowed as a deduction in PGBP head of income. It is allowed as deduction. Sir, what if the selling price is more than WDV? If selling price is more than WDV, then you have to see whether the selling price is still more than cost or less than cost. So if selling price is more than WDV but below the cost price, then whatever difference is there, no, it will be treated as balancing charge, and it is an income under PGBP head of income. Income under PGBP. However, if selling price is more than the cost price, then whatever up to the cost price will be considered as balancing charge, above the cost price will be considered as capital gain. Up to cost price, so WDV to cost price, sorry, selling price to WDV to cost price will be considered as balancing charge. Selling price minus cost price will be considered as capital gain. So hence in this case, in straight line method, there is no concept of capital loss karna, there can only be capital gain. Okay. Now let's talk about section 50AA, market linked debentures. Market linked debentures. This market linked debenture concept is very simple. Karna, people used to invest in fixed deposit and earn the interest. Whenever interest you are earning, that interest you are paying the tax under the normal tax slab. Okay, that is the up to 0 to 2,50,000 nil, then 5%, 20%, 30% slab, or in the new tax regime, the new tax regime slab. Fine. However, sometimes what people used to do, people used to invest in FD indirectly so that they can pay lower tax. So what they will do, they will invest in a mutual fund. That mutual fund will invest in a FD. That mutual fund will earn the interest and the value of the units keep on growing. Then what will happen? The assessee will keep this mutual fund unit for a long term period of time, and after long term, whenever the assessee is selling this mutual fund, whatever amount is received on that, tax will be the income will be taxed at normal long-term capital gain rate of tax. So what did I say? Whenever the assessee is selling the units of the mutual fund, okay, and if at all it becomes long-term, then the income will be taxed at long-term capital gain rate of tax, which is 12.5%. So 12.5% is lower than 30% now. So people started taking the benefit of this section. Instead of directly depositing in FD, they will deposit in mutual fund. Mutual fund will deposit in FD or bonds or debenture, as the case may be, so that they can pay lower tax. However, to remove this type of malpractice by the people, assessees, that is why the government told, wherever there is a mutual fund or any other specified asset which is investing in the debt class, okay, which means they are investing in deposits or bonds or debentures and getting the interest income, they will always be considered as short term. They will never be considered as long term. If they are considered as short term, then what will happen? Short term capital gain is always taxed at normal tax rates. So here also same tax rate, there also same tax rate. Fine. So what does the section say? The capital gain on the following capital asset will always be considered as short term. So what are they? Unit of specified mutual fund acquired on or after 1/4/2023, market linked debenture, or unlisted bond or unlisted debenture. So what did I say? Specified mutual fund acquired on or after 1/4/2023, market linked debenture, unlisted bond or unlisted debenture. Sir, what is the specified mutual fund? Here there is an amendment also. The definition has changed. Specified mutual fund means mutual fund which invest more than 65% in debt and money market instruments, or any other fund which invests 65% or more funds in a fund which is referred in clause A above. So if a fund is investing more than 65 in debt and money market instrument, that is a specified mutual fund, and any fund which is investing 65% or more in such mutual fund also will be considered as specified mutual fund. Now specified mutual fund, market linked debenture, unlisted bond, unlisted debenture. So all these assets are always considered short term. That is only the section karna. It is always considered short term. So whenever you are calculating the capital gain, you need not see the period of holding of the asset. You always consider it as short-term capital gain or short-term capital loss and solve the question. Fine. So in period of holding concept, this is also one exception that I have given, that section 50AA, always the assets will be considered as short-term only. Okay. Now let's come to next point. What is market linked debenture? Market linked debenture means a security which has an underlying principal component in the form of debt security, where the returns are linked to the market returns on other underlying securities or indexes. It includes any security classified or regulated as a market linked debenture by the SEBI. So you read this definition also one time, if at all it is tested in MCQ. Fine. Now let's talk about section 50B, slump sale. Very important, very important for the examination point of view. If at all question comes, it will directly come for 8 to 10 marks in the examination. Single question. Fine. And from past few attempts, the examiner has not even tested, so chances that it can come in the examination. So what is slump sale karna? Slump sale means an undertaking or a business as it is sold from one person to another person without deciding what is the value of the individual assets. Okay, so for example, one business is there, I have sold that business for 100 crores, but I have not seen what are all the each and every asset, and for that I have not fixed the value separately. I have just decided what is a lump sum value of this business. This is slump sale. In slump sale, how to calculate the capital gain? Let us see. In calculating capital gain, first you have to take full value of consideration. What is the full value of consideration? Full value of consideration in case of slump sale is FMV1 or FMV2, whichever is higher. So fair market value 1 or fair market value 2, whichever is higher. What is fair market value 1? It is the fair market value of the capital asset transferred during the slump sale. So FMV1 means what? Whatever capital asset are transferred, for that you calculate what is the fair market value. You add all of it together, that is only fair market value 1. Then you see what is FMV2. FMV2 is what? Consideration received. So monetary plus non-monetary, whatever is the amount received from the buyer, that is only called fair market value 2. Okay, so see fair market value 1 or fair market value 2, whichever is higher, the higher value will be taken as full value of consideration. From that you reduce the transfer expense, you will get the net consideration. From net consideration, you can reduce cost of acquisition. Now how to take the cost of acquisition, sir? Cost of acquisition in case of slump sale means net worth of the undertaking. Net worth of the undertaking. Sir, how to calculate net worth? Net worth is very simple. Net worth is equal to all the assets minus all the liabilities. In liabilities, you should not take share capital. Okay, so all the assets minus all the liabilities. So in case of asset, the asset can be depreciable asset or other than depreciable asset. If the asset is a depreciable asset, then take the opening WDV as per the Income Tax Act. Opening WDV as per Income Tax Act. And what about other than depreciable asset? For other than depreciable asset, take the book value. Take the book value. But you know what? If at all there is any revaluation, then you should remove the revaluation. So let's say there is a building. That building was only for 20 lakhs, but it was revalued to 80 lakhs. So that 60 lakhs balance is there. Now it will be transferred to revaluation reserve account. That revaluation reserve account will be there in liability side. In such case, what should you take as the value of building? Only 20 lakhs. So whatever revaluation amount is there, no, that you should remove. Only the original amount should be there. Then what about liability? For liability also you have to consider only the book value. So depreciable asset, you have to take WDV, opening WDV, then other asset book value, remove the effect of revaluation, and liabilities you take the book value. Finally, you will get assets minus liability, you will get the net worth. If the net worth is negative, then don't consider the net worth, take the cost as 0. So don't put negative cost. If net worth is negative, take the cost as 0. Then if deduction is claimed under section 35 AD, then for such asset you have to take the value as 0. If deduction is claimed under 35 AD, that is specified business in PGBP, take the value of the asset as 0. And if there is a goodwill, but if it is self-generated, then take the value as 0. So self-generated goodwill, take the value as 0. Then period of holding. Here what is the period of holding? Period of holding should be taken from the date of incorporation till the date of slump sale. Okay, and here generally in period of holding you have seen only two categories, that is 12-month category and 24-month category, but slump sale is 36-month category. Okay, so up to, if undertaking is held up to 3 years, it is considered as short term. If undertaking is considered held for more than 3 years, it is considered as long term. So this is 36-month category. So this also is an exception to period of holding concept. Okay, and in slump sale, our report, that is chartered accountant report, indicating and certifying the computation of net worth shall be submitted 1 month prior to the due date of return of income. Okay, so CA report is also compulsory in case of slump sale. So you reduce the cost of acquisition, you will get the long term or short term capital gain. And here you have to make sure that if it is 36 months, so above 36 months long term, up to 36 months short term. Now let's talk about section 50C, deemed full value of consideration for land or building or both. Karna, in case of land or building or both, whenever the sale transaction is taking place, then you might have heard that there is a lot of black money is also involved. Let's say 100 crore worth of property is sold from one person to another person. In such case, sometimes what happens, 60 crores is black money, 40 crores is only white money. In such case, the government is very, very angry because so much of black transaction is happening. And since the official value is shown as only 40 crores, that is why the tax is also paid very, very less and the government is not getting the revenue. That is why the government told that we are not able to catch you red-handed. It is very, very difficult. If we catch you red-handed, then you are gone, Karna. Then you have to worry very much. However, if we are not able to catch you red-handed, then also we need some check and balance in place. That is why the government brought section 50C in the Income Tax Act. What does 50C tell? 50C tells that you have to compare 110% of sale consideration with stamp duty value. So take the sale consideration, you add 10%. So take 110% of sale consideration. Now you compare this with stamp duty value. If stamp duty value is more than 110% of sale consideration, then you have to consider stamp duty value as the full value of consideration. But if stamp duty value is within 110% of sale consideration, then full value of consideration can be taken as sale consideration itself. So what did I say? You have to take 110% of sale consideration, compare with stamp duty value. Stamp duty value, if it is still higher, take stamp duty value as full value of consideration. But if it is within the 110%, then take sale consideration itself as the full value of consideration. However, sometimes the assessee might be angry. The assessee will feel that market rate is very, very less. Stamp duty value is unnecessarily high. That is why the assessee will go to the assessing officer. Assessing officer will refer the case to valuation officer. Now valuation officer will decide whether the stamp duty value should be increased or decreased. If the stamp duty value is being decreased by the valuation officer, then you take it because it is beneficial for you. Okay, if the stamp duty value is decreased by the valuation officer, then you take it because it is beneficial for you. But if the stamp duty value is being increased by the valuation officer, then ignore it. Ignore the valuation officer value because it is not beneficial for you. So what did I say? If the assessee is not happy with the stamp duty value, then the assessing can apply to assessing officer. Assessing officer will refer the case to valuation officer. Valuation officer can either increase the value or decrease the value. If he is decreasing the value, it is beneficial, so you take the value by valuation officer. But if they are increasing the value, then you ignore the value of the valuation officer. Then you go by the normal provision itself. Okay, wow. Now, Kana, in which date we have to take the stamp duty value? Should we take on registration date or should we take on agreement date? Kana, generally you have to take the registration date only. Generally registration date. However, if agreement was done before itself and if on or before the date of agreement, if any amount has been paid through prescribed modes of payment, that is account pay check, account pay bank draft, electronic clearing system or any other prescribed mode like credit card, debit card, net banking, UPI, NEFT, RTGS, okay, Bhim Aadhaar Pay, all those modes, if you are making the payment, then you can take agreement date stamp duty value also. Fine. So what did I say? Generally registration date. However, if on or before the date of agreement you have paid through prescribed mode, then you can take agreement date stamp duty value also. So that stamp duty value can be considered. Okay. So this is 50C deemed full value of consideration. Now listen, this 50C provision is there. No, update the same provision is also there in section 43CA for PGBP. So if the capital asset being sold, if it is a if the land and building being sold, if it is a capital asset, then see 50C. Okay, well, if the land and building that is being sold is a stock in trade, then you have to see section 43CA. Okay, but the rules and regulation, everything is same as 50C, same will be applying to 43CA as well. Okay, and this valuation provision also is the same, and stamp duty value also, on which date you have to take, that provision is also same. Similarly, when you see section 56(2)(10) in income from other sources, there I have discussed about when the person is receiving an immobile property without consideration or for inadequate consideration, then the assessee has to pay tax under 56(2)(10). There also similar provisions are there. There also, if at all the assessee is not happy with the stamp duty value, assessee can go for valuation officer. There also you have to see what is the stamp duty value date. Same provision are copy paste there also. Okay, wow. This I have also discussed in the income from other sources revision lecture, so don't worry. Now let's come to section 50CA, capital gain on unquoted shares. Sir, what is unquoted share? Unquoted shares means unlisted shares. Okay, if at all there is unlisted shares, then you have to see if sale consideration is less than fair market value. If sale consideration is less than fair market value, then full value of consideration will be taken as fair market value. Fine. Now let's talk about 50D. Sale consideration cannot be determined. Sir, some asset is sold, but we can't even determine what is sale consideration. For example, I have sold my property to another person and I told them, instead of this property, you please give me movie and popcorn every week till I die. Till I die, you please sponsor movie for me and popcorn for me. So what is the sale consideration? Can you find out the value of movie and popcorn till I die? Answer is no. In such case, how to decide what is the value of sale consideration? In such case, sale consideration, fair market value of the asset on the date of transfer shall be taken as full value of consideration. Fine. Now let's talk about section 51, advance money forfeited. Advance money forfeited. What is advance money forfeited? Whenever a sale transaction is taking place, the seller will first take an advance from the buyer. Okay. Later on, the remaining payment also will be taken and the property will be sold. Sometimes what will happen, after giving the advance, the buyer will say, no, now I am not interested to buy your property. So now the seller will tell, okay, you are not interested. No, this advance also I will not return you back. I will keep this advance with myself. This is called advance money forfeited. In case of advance money forfeited, it is an income for the assessee. That is why from 1/4/2014 onwards, whatever is the amount of advance money forfeited will be treated as income under income from other sources under section 56(2)(9). Okay, it is taxed in the year of receiving the advance. But then before 1/4/2014, what was the position? Before 1/4/2014, whenever there is an advance money forfeited, that has to be reduced from the cost of acquisition of the asset. From the cost of acquisition, you have to reduce before doing the indexation. If at all indexation is applicable, before indexation you have to reduce. So let me give you an example. Let's say there is a father Kanna. In 2002, he had bought a property for 1 crore rupees. Then in 2005, he had received an advance of 10 lakh rupees for selling the property, but later on the buyer told that I don't want the property, so he got the 10 lakhs for himself. He got to keep it for himself. But this was in 2005. If it was on or after 1/4/2014, it would have been treated as income. Okay, but it was before 2014. So what you have to do? You have to reduce from the cost. Later on what happened? Father has gifted the property to the son in 2010. In 2012, the son had received advance money forfeited of 20 lakh rupees. This 20 lakhs, since it is before 1/4/2012, what you have to do? You have to reduce it from the cost of acquisition. Later on, in 2015, again he received advance money forfeited. But this time, it is on or after 1/4/2014, no. That is why entire advance will be treated as income under section 56(2)(9). And it will be taxable under income from other sources. Now, in finally 2025, the property was sold for 10 crore rupees. 10 crore rupees. Now listen, the son is there, no? He has received the property. When son is receiving the property, will the father pay any tax? Answer is no, because the income tax department or income tax act will close its eyes. I already told you. When the son is receiving, will the son pay any tax? Answer is no, because in 56(2)(10 in income from other sources we will learn that when the property is received from a relative, it is not taxable. Okay, but when the son is receiving, now what will happen? What should be taken as cost of acquisition? Cost of acquisition should be taken from previous owner, that is from the father. Okay, period of holding also should be taken from the previous owner, that is from the father itself. You have to take period of holding. Indexation also should be taken from previous owner. So this I have revised all the previous provisions. Now listen carefully. Advance money forfeited. No, the section tells that if you have acquired the property, then in your property only you can reduce from the cost. So when the son has received the property, no, whatever advance was forfeited by the father, that need not be reduced by the son. If the father was having the property, he should reduce. But for the son, only if he has received some advance money forfeited, he should reduce. But if it was received by the father, he need not reduce. So hence, in this case, in 2005, whatever 10 lakhs was received by the father, it went tax free. Because when you are selling the property, while selling the property, only if you have received any advance money forfeited, you have to reduce. But if previous owner has received, you need not reduce it. Okay, well, so this is the point I was trying to say. And you have to reduce before indexation. If at all you are calculating indexation, before indexation it has to be reduced. So to be deducted from the cost of acquisition or FMV as on 1/4/2001 before indexation while calculating the capital gain. Only if forfeited by present owner. If it is forfeited by previous owner, then you have to ignore the advance money forfeited. Okay, well. Hence, in the year of transfer of capital asset only, it indirectly gets taxable. Now let's talk about section 55A. It is a theoretical section only. You can give a reading. Let me jump to section 54 series exemption. Section 54 series talks about exemptions. There are 5 exemptions, Kana. In your examination point of view, 54 is important for you. Okay, well, then 54 EC is important for you and 54F is important for you. So be thorough with these 3 sections. Other sections also you go through and go. First section alone I am going to teach you in detail. Balance sections you will automatically be able to understand. Okay, well, then I will go fast. So first section alone, let me teach you. Firstly, section 54, it talks about capital gain on sale of residential property used for residential purpose. So when can you claim the exemption, sir? Firstly, who can claim exemption? Assessee being individual or HUF can only claim the exemption. On what type of asset? Only on long-term capital asset. Then what is the asset transferred? A residential house property being land or building, being a building or land appurtenant thereto. So what is the new asset to be purchased? New asset purchased is also residential house property in India. So what does this section say? Section 54 is applicable only if there is an individual or HUF. Individual or HUF has a long-term capital asset being a house property. House property is being sold and with that money they are using to buy another house property. With the capital gain they are buying another house property. Only then this section is applicable. Okay, well, so one property being sold, another property is being purchased using the capital gain. So now what is the property sold? Residential house property being a long-term capital asset. New asset to be purchased is one residential house property in India. The assessee can purchase also, assessee can construct also the new property. If the capital gain value is up to 2 crores, if it is up to 2 crores, then the assessee can invest in 2 houses also. But this 2 house benefit is only given once in a lifetime to the assessee. So if the capital gain is up to 2 crores, so within 2 crores, he can invest in up to 2 houses. This 2 house benefit is given only once in a lifetime. But other than that, if it is above 2 crores, then the assessee can only invest in one residential house property. Then time limit. For purchasing or constructing the time limit, what is that per new property? What is the time limit? So it is -1 + 2 + 3. -1 + 2 + 3. It means what? Within 1 year before or 2 years after, the person can purchase the property, and within 3 years after the date of transfer, the person can construct the property. So within 1 year before or 2 years after the date of transfer, purchase the new property, or within 3 years after the date of transfer, constructed the new property. Sir, why 1 year before time is also given? Because generally before buying a new house, first you will buy the new house, then only some people will sell the old house, because after selling the old house you want to go somewhere. No, that is why generally what people will do, people will buy a new house first, then they will sell their old house. Okay, well, that is why -1 + 2 + 3 time is given. 1 year before, 2 years after, or 3 years after for in case of construction. Then deposit scheme. Listen, Kanna, the capital gain is there, no? Okay, it will arise in the previous year 25-26. Okay, the due date to file the return of income is 31/7/2026. Let's say the transfer took place on 1/1/2026. Then from 1/1/2026, the assessee is having 3 years time. So 27, 28, 29 till 31/12/2028, the person is having the time to construct the property. But the return filing due date is just 31/7/2026. Now what to do? In such case, if the person wants to claim the exemption for 25-26, he has to prove that he is going to invest in the new property before 31/12/2028. So to prove that, what can the person do? The person has to deposit the amount in capital gain account scheme. Capital gain account scheme is nothing but a bank account. It is a special bank account in which you deposit the money and you tell in your return of income that I have deposited. If you are depositing money in the capital gain account scheme, then the income tax return, it will be treated as if you have invested in the new asset and exemption can be claimed. Exemption can be claimed. So whatever this deposit amount is there, no? From this, you have to use the amount to buy or construct the house within the time limit. If you are using within the time limit, then it is well and good. But if you are not able to use and the time limit is over, then you have to reverse the capital gain. You have to reverse the capital gain exemption. Okay, wow. So now let me tell you about deposit scheme. So deposit scheme is applicable and up to 10 crores can be invested in deposit scheme. Sir, why 10 crores? Because in this section, maximum exemption is 10 crores. Maximum exemption 10 crores. Now let's talk about exemption. So what will be the exemption value, Kana? Exemption value will be capital gain amount or cost of new asset or deposit amount up to 10 crores, whichever is lower. Whichever is lower. So capital gain amount or cost of new asset or deposit amount, whichever is lower, will be the exemption. Maximum 10 crores. Maximum 10 crores. Transfer of new asset. Now this new house is there, no? Because of which you have got the exemption. This new house should not be transferred up to 3 years. If it is transferred within 3 years, then cost of acquisition of the new asset shall be reduced by the exempt capital gain. So for that new house, whatever cost is there, no, that cost you have to reduce by the capital gain which was exempt earlier. So what did I say? You cannot purchase any new house. Sorry, you cannot transfer this new asset within 3 years. So listen here. Let's say there is a person. Okay, in this example itself, let me tell you. Let's say one asset has been constructed on 31/7/2028. So now within the time limit, construction is complete. Now when the construction is complete for the new property, this new property cannot be sold for 3 years. So 31/3/28, 29, 30, 31. Up to 31/7/2031. This new house also should not be sold. If the new house is sold within 31/7/2031, then what will happen? You will find out what is the full value of consideration. That is the selling price, correct? Minus cost of acquisition. You will reduce the cost, no? In this cost, you have to reduce, while calculating the cost, you have to reduce the 54 series exemption that you have claimed. Section 54 exemption should be reduced. Balance amount should only be taken as the cost. So if you reduce it from the cost, what will happen? Automatically your capital gain in that year will increase. So that is the concept. So now let me tell you about this section once again. Then all the other sections quickly I will finish. So section 54, when is it applicable? It is applicable when an individual or HUF sells a house property which is a long-term capital asset and using the capital gain amount, they invest in the new house property. This new house property should also be in India. If the capital gain is up to 2 crore rupees, they can invest in 2 house property, but this 2 house property concept is applicable only once in a lifetime. But other cases, if the capital gain is more than 1 crore, more than 2 crores, they can invest only in one house property, one new house property. Now, what is the time limit to invest? The time limit to invest in case of purchase is -1 + 2. That is 1 year before the date of transfer or within 2 years after the date of transfer. And in case of construction, it is +3. Within 3 years after the date of transaction also, you can complete the construction of new house. Now deposit scheme. The return filing due date will be coming before itself. Within the return filing due date, if the assessee has not purchased the new house or constructed the new house, then whatever amount of capital gain is there, he should deposit in the CGAS account, capital gain account scheme account. in the bank account. This detail should be given in the income tax return. If detail of this deposit scheme is given in the return, then the income tax department will assume that you are going to invest, and that is why they will give you the benefit of the exemption. So what is the exemption? The exemption is capital gain or cost of new asset or deposit amount, whichever is lower. However, maximum capital gain exemption can be 10 crores. More than 10 crores, you cannot claim exemption. Then this new house is there now, whichever is purchased or constructed, that also has to be held for at least 3 years. Within 3 years, you cannot transfer. However, if you are transferring within 3 years, then whatever exemption was claimed earlier, no, that exemption, you reduce it from the cost of acquisition of the new asset. Fine. So this is the concept. Now other sections, let me quickly finish. Section 54B talks about capital gain on sale of urban agricultural land and used for another agricultural land. It is applicable for individual or HUF. Then asset can be short term also, it can be long term also. What is the asset transferred? Asset transferred is urban agricultural land used by an individual or his parents for agriculture purpose at least for 2 years before the date of transfer. In such case, whenever agricultural land is transferred, then they can purchase a new agricultural land. Here there is no scope of construction because agricultural land is being purchased. What is the time limit? +2. That is within the date of transfer. From the date of transfer, 2 years time is given to purchase the new agricultural land. Here also deposit scheme is applicable. And here also, what is the capital gain exemption? Exemption is equal to capital gain or cost of new asset or deposit amount, whichever is lower. Then, if new asset is transferred within 3 years, then cost of acquisition of the new asset shall be reduced from the exempt capital gain. Same concept. Now let us come to section 54D. Compulsory acquisition of industrial land and building, and the amount is used for new land and building. So this is applicable to all the persons, company, firm, HUF, AOP, BOI, everyone can take benefit of section 54D. When is this section applicable? If the asset is short-term capital asset or long-term capital asset, it does not matter. The asset should be a land or building which was used by the assessee in the business of industrial undertaking for at least 2 years before the date of transfer, and it should be compulsorily acquired by the government. In such case, whenever the compensation is received, from the date of compensation you have 3 years time. Within the 3 years, the person has to invest in new land or building for industrial undertaking. Here also deposit scheme is applicable, and the exemption is capital gain amount or cost of new asset or deposit amount, whichever is lower. Then here also this new industrial land or building should not be transferred within 3 years. If it is transferred within 3 years, then you reduce the exemption amount from the cost of acquisition. Fine. Then in all the cases, whenever there is compulsory acquisition, the time limit will start from the date of receipt of compensation. That you have to keep in mind. So deposit scheme I have already told. If the deposit scheme amount is unutilized, then it will be taxable as capital gain in the year in which the time limit will expire. This also I already told you. Now let's talk about section 54EC. Section 54EC, investment in certain bonds. It is applicable to all the persons. So anyone can use the section 54EC. And in exam point of view, I feel that 54EC is even more important because there is an amendment also. 2 new bonds have been added in the section. So to whom is it applicable? To any person. Okay, any person can take the benefit. The nature of asset transferred is a long-term capital asset being land or building or both. So if land, building or both is transferred, and if it is long term, then whatever capital gain amount is there, this capital gain amount you can invest in the bonds that are redeemable after 5 years. So there is a 5-year lock-in period. After 5 years only you can get the maturity value. Sir, where and all we can invest? You can invest in NHAI, RECL, PFCL, RFCL, HUDCO bond and IREDA bonds. So NHAI, RECL, PFCL, RFCL, HUDCO and IREDA bonds. So NHAI means National Highway Authority of India, then Rural Electrification Corporation Limited, Power Finance Corporation Limited, Indian Railway Finance Corporation Limited, then Housing and Urban Development Corporation Limited from 1/4/2025, then Indian Renewable Energy Development Agency from 9/7/2025. So this alone date you have to remember, Kanna. Only if you are investing on or after 9/7/2025 you will get the benefit. Before 9/7/2025 there is no benefit. Fine. Now, how much amount can be invested, sir? Answer is 50 lakhs. So here also you can only save up to 50 lakhs as exemption. Maximum exemption is how much? 50 lakhs. Maximum exemption 50 lakhs. What is the time limit? The time limit is 6 months from the date of transfer of original asset. So from the date of transfer of land and building, there is 6 months time. Within 6 months, you have to invest up to 50 lakh rupees in the bonds. Whatever amount is invested up to 50 lakh rupees can be claimed as exemption. Here deposit scheme is not applicable kana because only 6 months time is given. No, even if return filing date is coming earlier, then before the return filing date itself, you invest in the bonds. Next, amount of exemption. Capital gain or cost of new asset up to 50 lakhs, whichever is lower. Here transfer of new asset. So there is 5-year lock-in period no for the bonds. So for 5 years, you should not sell that bond to anyone. You should not take maturity of the bond. Also, you should not take any loan against the bond. If you are selling the bond or taking the maturity, or if you are taking the loan against the bond, in such case, whatever exempt capital gain is there, no, it will be taxable in the year of transfer or conversion. Fine. Now let's talk about section 54F. 54F also important. 54F speaks about individual RHF where they are transferring a long-term capital asset which can be any asset other than residential house property, and they are investing in residential house property. So listen, what did I say? In section 54, no? In section 54, what did we learn? That individual RHF is transferring long-term capital asset being house property, investing the money to buy another house property. So one house they are selling and another house they are buying. So for that you have to see section 54. But what about 54F? 54F applies when any asset other than house property is being sold and the amount is being used to invest in a new residential house. Okay, so if you are selling house and buying house, then you go to section 54. But if you are selling any other asset and buying a house, then you have to come to section 54F. But you know what? In 54F, there is a different rule than other sections. In all the other sections, we have learnt that the capital gain amount should be invested. But in 54F, you should not invest the capital gain kana, you have to invest the net consideration. Net consideration should be invested in the new asset. So here, what is the time limit to invest in new asset? Here also -1 +2 +3. So -1 +2 for purchase +3 for construction. Here also maximum up to 10 crores only exemption can be claimed. Amount of exemption is equal to, here you have to do proportionate calculation karna. All the other places you have seen that only capital gain should be invested. But here what should be invested? Net consideration should be invested. That is why the proportionate exemption will be cost of new house multiplied by capital gain divided by net consideration. Cost of new house multiplied by capital gain divided by net consideration up to 10 crores will be exempt. Then this new asset is there, no, new house, that you should not transfer up to 3 years. If you are transferring within 3 years, then you have to reverse the capital gain. Reverse the capital gain. And there are some additional conditions also for 54F. What are they? The assessee should not own more than one residential house. So while purchasing this residential house, maximum one more house he can have. More than that he cannot have. Then assessee shall not purchase any residential house within the time prescribed other than the new asset. If this is not satisfied, then the exempted capital gain will be taxable in the year of purchase or construction. So this new house that the assessee is buying, no, up to 3 years, this house also should not be sold, and the assessee should also not buy any other house also within the 3 years. So that is also a rule. So what is the rule? First rule is that when while buying the new house, he should not have any other house. Maximum one house he can have. So while buying the new house, he can have maximum one house. And this new house also, he should not sell for 3 years. He should also not buy any other house for within 3 years. So that is the rule for 54F. So these are all the exemptions kana. Now let us learn about tax rates for capital gain. Tax rates. So tax rates discussion. Let me tell you about tax rates first. In capital gain, you can either have short-term capital gain or long-term capital gain. Short-term capital gain, there are two types of capital gain. Capital gain on certain assets and other assets. In long-term also, there is capital gain on certain assets and other assets. Short-term capital gain on certain assets is taxable under section 111A and the tax rate is 20%. Short-term capital gain on all the remaining assets are taxable at slab rate, that is normal tax rate. Long-term capital gain, certain assets is taxable under section 112A. 112A. In 112A, no kanna, there is a slab rate, that is up to 1,25,000 there is no tax, above 1,25,000 12.5% tax. But other assets are taxed under section 112 where the tax rate is 12.5% without indexation, and only in certain cases 20% with indexation, whichever is lower. So let us study. Firstly, let me tell you about the common points for these tax rates. So 111A, 112 and 112A, that is short term capital gain on certain assets, long term capital gain and long term capital gain on certain assets. For all these three sections, these are special sections, special rate sections. So there are some points that you should remember. What are they? Number one, only resident individual and HUF can adjust the income against unutilized basic exemption limit. So let's say you are having an income, other income or normal income of 2 lakh rupees, and you are having 111A income of 3 lakh rupees. Your basic exemption limit is, let's say in the old scheme, let us assume that the assessee is going for old scheme, so it is 2,50,000. So what you have to do, always when you are having basic exemption limit, you should not get confused whether I should use basic exemption limit against 111A income or first I should use against other income. Always first you should use basic exemption limit against other income. So first use the other income, 2 lakh rupees you use. Balance basic exemption limit is how much? Balance is 50,000. So this balance basic exemption limit you use against 111A income. So 50,000 you reduce. So taxable 111A income will be 2,50,000 multiplied by 20%. If at all there is rebate, then rebate also can be reduced. You get my point? So always when you are having basic exemption limit, first use the other income, that is slab rate income, to reduce the basic exemption limit. But if you are having 111A income, 112A income and 112 income, then you can reduce against unexhausted or unadjusted basic exemption limit, which is nothing but this 50,000. So only resident individual and HUF can adjust the income against basic exemption limit, which is unutilized. Okay, if an individual or HUF is not a resident, then you cannot use the basic exemption limit to adjust these incomes. Fine. Then chapter 6A deduction is not allowed against 111A, 112 and 112A. Next, section 87A rebate in the old regime is not allowed against 112A income, but it will be allowed against 111A and 112 income. And lastly, in new regime, that is default tax regime, 87A rebate is not at all allowed against any special rate of tax. So not allowed for 111A also, 112 also, 112A also. So these are the special points. Now let us talk what are the tax rates. Firstly, short-term capital gain other than 111A is taxable as per normal tax rates. Fine. Then 111A, short-term capital gain on certain assets. So what are these certain assets? It is applicable to the following assets on which security transaction tax should have been paid on transfer. Okay, what are the assets? Equity shares of a company, units of equity oriented fund and units of business trust. So for equity oriented company, equity shares of a company, units of equity oriented fund and units of business trust, if at all during the sale of this asset STT has been paid, then such asset will be taxable under section 111A. What is the tax rate? It is 20%. So tax rate is 20%. Fine. However, if at all the trade has taken place in IFSC, that is International Financial Service Center, in IFSC, STT is not necessary. So if at all trading has taken place in IFSC, then you need not see whether STT has been paid on transfer or not. Directly you can apply 111A. Fine. Meaning of equity oriented fund means minimum 65% of total proceeds is invested in listed domestic company, and if there is any other fund, minimum 90% of total proceed is invested in a fund, and such fund invests minimum 90% in equity shares of a listed domestic company. These are only equity oriented funds. Now let's talk about section 112A, long term capital gain on certain assets. So here also this section is similar to 111A. So it is applicable on the following assets on which STT has been paid on transfer except IFSC. So what are the assets? Equity shares of a company, units of equity oriented fund and units of business trust. So these three assets, if the STT has been paid on transfer, and here there is one small change Kanna. In case of equity shares of a company, STT should have been paid on purchase also. So in case of 112A, that is long term capital gain of certain assets, in case of equity shares, STT should have been paid on transfer also, it should have been paid on purchase also. Only then it is covered under 112A, or else it will be covered under 112. then units of equity oriented fund and units of business trust. For all these three, what is the tax rate? The tax rate is 12.5% in excess of 1,25,000. It means what? It is a slab rate of tax. Up to 1,25,000 the tax is 0. Above 1,25,000 the tax is 12.5%. 12.5%. Okay. Then section 55, cost of acquisition for purpose of computing shall be determined as follows. Now listen Kanna, before 1/1/2018, that is up to 31st January 2018, the capital gain in case of 112A used to be fully exempt. There was no tax at all for this 112A. However, from 1/2/2018 onwards only tax has come. So that time no people got very angry that why are you putting tax on us? That is why the finance minister told in the budget space itself that whatever capital gain has been earned up to 31/1/2018 for the entire capital gain, it will always be exempt. That is why if at all I have purchased any shares before 31/1/2018 on or before 31/1/2018, whatever capital gain I have earned up to 31/1/2018 will always be tax free. That is why whatever profit is there now up to 31/1/2018, that you have to include it in the cost. You have to include it in the cost so that it becomes tax free. So how to find out the cost? Using the grandfathering rule. So what you have to do? You have to see whether the asset is acquired before 1/2/2018. In such case, take the fair market value as on 31/1/2018 and full value of consideration whichever is lower. Full value of consideration whichever is lower. Then higher of the step 1. Value as per step 1 or actual cost of acquisition whichever is higher. So what you have to take? Fair market value or full value of consideration whichever is lower. Okay, lower value or actual cost whichever is higher will be taken as cost of acquisition. Cost of acquisition. If at all it is a bonus share, then in case of bonus share the value will be 0, or if the bonus share has been received before 1/4/2001, the value will be FMV as on 1/4/2001, which we have already discussed. So now what to do? How to do grandfathering? Very simple. Fair market value on 31/1/2018 or full value of consideration whichever is lower, then whichever is lower or cost of acquisition whichever is higher will give you the final cost of acquisition. This cost of acquisition only you have to use for calculating the capital gain. This you be very thorough. One question is also there in your material. Make sure to solve that question. You will be comfortable with the grandfathering calculation. Now let us see how to calculate this fair market value as on 31/1/2018. If the shares are listed, then the fair market value shall be highest price that is quoted on a recognized stock exchange on 31/1/2018. However, if no trading took place, take the highest price on the immediately preceding trading date. So as on 31/1, what is the highest price you have to take? And if no trading took place, then in the preceding trading date, whatever is the highest price that you have to take. Now what if the shares or units are unlisted? If shares or units are unlisted, then in case of units, you have to take the NAV as on 31/1/2018. Here you have to be very careful, Kanna. Listen, very important, that if units are listed, then take highest price on recognized stock exchange. Fine. Don't take NAV. So this silly mistake students do. Students will see units. Units means they will take NAV as on 31/1/2018. It is not like that. If unit is listed, then you should not take NAV. You should only take which is the highest price on the recognized stock exchange. If unit is unlisted only, you have to take the NAV. Fine. Now what about unlisted shares? If there is unlisted shares as on 31/1/2018, then you have to do indexation for the shares. Indexation is equal to cost of acquisition multiplied by cost inflation index of 2017-18 divided by cost inflation index in which it was first held, or 2001-2002, whichever is later. Fine. So this is the indexation you have to do. 272, should you remember? Answer is my recommendation. You please remember it. If at all it is not given in question, you should be able to answer. So cost of acquisition into cost inflation index of 17-18 divided by cost inflation index in which it was first held, or 2001-2002, whichever is later. normal indexation you have to do. So listed unit highest price, listed shares also highest price, unlisted unit NAV, unlisted shares indexation. Fine. Indexation up to 1718. Now let's talk about long-term capital gain on other assets. In case of other assets, long-term capital gain tax is 12.5% without indexation. However, there is an option to choose lower of 12.5% without indexation or 20% with indexation if these conditions are satisfied. So what are the conditions? The assessee should be resident individual or HUF, and the asset should be an immovable property, being a long-term capital asset acquired before 23/7/2024, and the transfer should take place on or after 23/7/2024. So what did I say? Resident individual or HUF should be having an immovable property which is purchased before 23/7/2024. It should be a long-term capital asset and it should be transferred on or after 23/7/2024. If all these conditions are satisfied, then such individual or HUF will get an option. What is the option, sir? That individual, while calculating the tax, they can take 12.5% without indexation or 20% with indexation, whichever is lower. So they can take whatever is beneficial for them. There is one question in the study material which is comprehensive question. It is covering advance money forfeited also, all these provisions also, that is for old tax also, new tax also. Definitely solve that question. It will be helpful for your examination to conceptually understand. So this is the provision karna. And indexation, already I told you. Cost of acquisition, if you are finding the indexed value, so cost of acquisition multiplied by cost inflation index in the year of transfer, or cost inflation index in the year of first held, or 2001-2002, whichever is later. Then in case of improvement, you have to do cost of improvement multiplied by cost inflation index in the year of transfer divided by cost inflation index in the year of improvement. However, if improvement is done before 1/4/2001, you should ignore the improvement. Indexation is not applicable from 23/7/2024 onwards. It was only applicable if the asset was transferred before 23/7/2024. So if such transfer is there, you have to do indexation. However, if transfer is on or after 23/7/2024, only if these conditions are satisfied, then while calculating the tax, you have to do indexation. While calculating the income, there is no indexation karna. Only while calculating the tax, there is indexation. Fine. If possible, that one question that I have worked out now, I will take a clip from that question and I will upload on YouTube so that you are able to familiarize yourself with the question and how to present in the examination. Fine. So I hope you are clear with this. All the provisions of capital gain is over. I hope you were able to understand the provisions. Understanding is very, very important in the capital gain chapter. You just go through the provision, go through the notes once again, solve the questions, and you will be good to go. You will definitely score high marks in the examination. That is a guarantee. See you in the next video, Kana. Till then, take care. Bye bye.